incoming data, in particular the more important data, it still shows the economy doing well.
Even with further progress, while welcome, it's still not enough to justify a top-line move in terms of monetary policy.
Interest rates have done their job. They've brought demand and output down from the peaks we saw.
I always say to people who want the Fed to start ASAP and move quickly, be careful what you wish for.
The more likely error right now is that the Fed will not start cutting early enough and then will overshoot on the way down yet again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance coming into Q3. Coming off the back of 3 consecutive quarterly gains on the S&P 500. We are hitting the ground in week 1. Absolutely running, stacked. Chairman Powell tomorrow, payrolls on Friday, and Lisa, a ton of economic data sandwiched in between.
It really kicks off today with the ISM manufacturing data. It has to do with this idea of whether we're seeing activity slow, and tomorrow we get jolts. Key question here is, does this confirm the weakness that people have been coalescing around over the past few weeks? Or does this fly in the face of that and really pressure the Fed to stay on hold for a bit longer than people currently are expecting?
Big question for us, big mission for us this morning. Politics absolutely colliding with financial markets. A question that CBS YouGov asked a range of individuals. Does the president have the mental and cognitive health to serve? That's the question. This is the response. Almost 3/4 of the electorate expressed doubts. Nearly half of his own party do not think he should be the nominee.
And 28% of registered voters do not believe that he should be running for president, meaning more than 70% believe he should not be running for president. Look, this comes down to this question of, does this make it more likely that Donald Trump is going to be president? And Morgan Stanley really put this to the test over the weekend, saying that if Donald Trump were to become president, you'd expect a steepening in the yield curve. Look, most people, when they think about this, are not thinking, what's the implication for the yield curve? At the same time, the fact that you have bond strategists starting to actively game out scenarios where Donald Trump is the more likely president tells you just how far things have shifted at this point.
I'm totally on board with you. This felt like day one to express some of those thoughts and start to suggest trades. This came from Mike Wilson of Morgan Stanley. Here's the quote. Risks are skewed to the downside for growth under Republican win scenarios due in part to immigration reform and tariffs. Now, let's be clear. These are things we've been talking about for a while, but I think they just take on some added importance after that debate Thursday evening.
If you just look at, for example, some of the prediction markets out there, they give Donald Trump about a 70% chance of winning at this very moment if he is running against Joe Biden. This raises a real existential question. How much pressure is this internally within Joe Biden's camp to really get him to step down and allow somebody else to take the place? Report after report this weekend saying that basically his insider circle saying, no, just keep on going, fight, defiance, that's the way to go. You just wonder how far that will go given the fact that you have major publications that are traditionally skewed to the liberal side saying, hey, Joe Biden, it's your time.
And this is US politics. We need to talk about French politics as well. If you pull up the board, the euro's rallying. French equities are doing nicely as well. And if you look at the comparison between the French 10-year and the German 10-year, that spread is narrowing. It's a slightly less convincing win, I think, than expected in round one of the elections for Marine Le Pen's party. Some tactical voting in the second round may blunt the right's advance, but I think there's still a ton of uncertainty here, Lisa, going into the second round.
I should say that's sort of an understatement, given the fact that people are rallying around the idea that Marine Le Pen's party got something like 32% versus 34% as polled. It's not exactly as if she didn't just get something that looks more and more like a majority. Key question to me is, can you get some sort of unity between Macron's party and the far left party? Can you get unity to try to fight Marine Le Pen? Or does that fall when you start to actually deal with the nitty-gritty of policy?
Quite a start to Q3. Can't believe it's July. Let's get straight to it. Your scores look like this on the equity benchmark on the S&P 500. Futures just about positive by 0.1%. Yields with a little bit of a lift here. We're up a single basis point, 440.79. Lisa, I don't know what you made of Friday's session, but double-digit move on a 10-year yield to close out the week, the quarter, and go into the weekend?
You know, I really don't know what to make of it other than perhaps people are taking a look at just how much we recalibrated some of the yield space. Honestly, heading out into this week, it really is going to be dominated about, do we get confirmation about the weakness? I think you are correct to focus on the yield space. Tomorrow we get the JOLTS data, and that's where it really begins for me, other than the ISM manufacturing today. The fact that JOLTS are going to come out, job openings, do you still get a real kind of feeling feeling of increasing slack in the labor market? And do people get more credence to that idea rather than some of the messy data that some people, even Jay Powell, has frankly cast some doubt as? We get a litany of central bank speak. Jay Powell tomorrow at the ECB's Sintra Portugal conference. We're also going to be hearing from John Williams. We're going to get Wednesday a crush of data ahead of the long weekend that some people are going to have to put a pause on Friday to get the jobs report. But really, if we get some of the jobless claims, do we start to see that ongoing uptick that you pointed out last week? And I think we should sit on this for a hot second. You pointed out it's been creeping higher. Can you just shrug that off as normalization? It has never in history just been a single line, a blip up, a boop, there we go. It has always been something that has been a more protracted increase in jobless claims that has become something that's much more worrisome.
Without a doubt, that's going to be a theme for us this week. And if you go through the estimates for Friday on the payrolls report, 190 is the estimate for the headline payrolls read, 272 the previous number. There are people out there that suggest the unemployment rate on Friday might be more important to what the Fed's going to do here than headline payrolls, given what Chairman Powell said to us in the last press conference.
Especially because we don't have an understanding of just how many jobs need to be created every single month in order to create a market that is fully employed. We have a different labor dynamic. We have a different population of workers. And that's something that we can't emphasize enough in our lack of understanding of what an appropriate, healthy labor market looks like in the numbers.
I know I say it basically every Monday morning, the week is stacked, but truly the week is stacked. This programme is too. The next hour looks like this. Marvin Lowe of State Street as the second half gets underway. We'll catch up with him shortly. Terry Haines of Pangea Policy as President Biden refuses to back down. And Pooja Kumra of TD following the first round of voting in France. We begin with our top story, kicking off the second half with comments from Fed Chair Jay Powell tomorrow and the US jobs report on Friday. Marvin Lowe of State Street writing this. Our base case remains that the world is different this time and stickier inflation along with tight labour markets will keep inflation higher than 2% in the intermediate term. We suspect the Fed may be done with its cutting cycle by the third quarter of 2025. Marvin's with us this morning. Marvin, good morning to you.
Good morning. How are
Before
you?
we talk about the cutting cycle ending, we need to talk about it beginning.
Yes.
When do you think this ultimately begins?
For sure. You know, we've been saying December for a while, so we'll just stick to that number. To me, December versus September is not really the big story. It's where we land when we're done with this that really comes into focus as we get closer to the start of the cycle.
Are people looking ahead to Friday suggesting that maybe the unemployment rate might be more important now than perhaps headline payrolls? Would you agree with that?
Yeah, I mean, you know, for sure, the whole full employment aspect of the dual mandate is challenging for the Fed. You know, the number that they try to put on it is the unemployment rate. It really is at their year-end target at this point, and with inflation going in the right direction, that's going to really create the September versus December type of discussion. So it is important, yes, for sure.
There's a question here at this point whether the Fed is currently leading increasingly dovish. There was a note from Andrew Hollenhorst of Citigroup over the weekend basically saying, look to what Fed Chair Jay Powell says, expect it to be much more dovish than the meeting minutes, which evidently we get and nobody cares about this week. How much do you agree with that? Is there this sense that the weakening in the market has sufficiently spooked Fed officials to really push them to maybe even consider an earlier rate cut?
Yeah, I mean, if you look at their commentary over the last 6 months, it really has surprised to this dovish side of things, beginning at the end of last year, you know, kind of confirming in the early part of the first quarter when they were willing to overlook some of the hotter data. It was only when the data forced them to really, you know, come to terms with an inflation profile that wasn't moving in the direction that they wanted, that they did that. So, yeah, I think that this Fed historically has wanted to lean dovish. Even though you've got important hawkish vocal voices, it goes with the chair. You know, the whole board moves with the chair in my mind.
How much has the Fed, in a way, been de-emphasized? And I say this as at a time where, as John was mentioning, politics very much front and center, and you see an increasing number of estimates saying that either candidate could potentially increase the deficit depending on the composition of Congress and could lead to a steepening in the yield curve. Is that something that you're coalescing around, that you're changing your view around, given what we're seeing currently transpire in the political sphere?
I mean, the Fed is always important. You know, don't get me wrong. The discount rate that everyone uses is, you know, the benchmark for all assets around the world. But kind of having said that, yes, we have been in the camp that we should be thinking about a bear steepening for quite some time, based on exogenous events that might not seem related, but will come together in terms of just what the clearing price for yields are. One of the more interesting things to me this morning is that while we've got, you know, let's say European assets rallying fairly aggressively, you've got yields higher, and you've got yields higher in the U.S. kind of following last week. There is a sense that politics and really this populist evolution around the world is going to affect the amount of debt that we all need to absorb.
Just go a little bit further here. Bear steepening means the longer end sells off more than whatever the front end does. So yields are going to climb. Can you just point to a specific policy that's going to lead to that outcome? What is it that's on the table that you think is going to drive that?
Well, if we're talking U.S., certainly, the discussion around a Trump candidacy, how he would approach immigration, which has been so important for the jobs market, as well as for growth aspects, and the amount of debt. Easily, you can get to that. Effectively, every one of the more controversial policies that the Trump administration is talking about is inflationary. So you get to that quite quickly. The amount of debt that we have is something that we've been talking about now for a while. We sound like the old bond hawks at this point, but it's a concern with the amount of debt that is scheduled to be released.
Given the policy mix, you could make the argument there would be a tailwind for inflation but a headwind to growth. And I'm just wondering from your perspective how you'd push that through fixed income. What would that look like?
Yeah, I mean, the easiest trade is a bear steepening for sure. That growth aspect, if you will, would require the Fed to be more vigilant just because it's facing a restricted interest rate that's too high. But it's the long end is much harder to control. Operation Twist is what they did to try to control it. But QT is still part of the process. And a $7+ trillion balance sheet gives them much less flexibility in my mind.
When do you start thinking about the signals being sent from the divergences that are going on in the equity markets and what that means for fixed income? At the same time that we've seen yields creep higher, we've seen this massive divergence with small caps declining 3.6% in the second quarter versus the overall index gain of almost 4% on the S&P. Some people saying this could potentially be a canary in the coal mine if it doesn't start to normalize soon. Do you take some signal from that kind of edifies this idea that we're seeing from some people that weakness is really the main story here? Just a lot of people aren't noticing it yet.
I mean, it certainly creates concern when you have a market that isn't, that's really showing this degree of dispersion. You would hope that it would start to positively affect more companies for sure. Kind of having said that, liquidity in the markets, I think, is a very, very important thing. We still have, again, record-sized balance sheets. That is a lot of liquidity that is supporting these asset classes. It is stark to me that it's these kind of stronger companies that have balance sheets that give them flexibility that are ultimately outperforming. And the earnings outlook, if you will, kind of from at least a market-weighted perspective, is still supportive of those risk assets. So, those stagflationary concerns could be a potential in administrative changes, but we're not really seeing it now. And I think we have to trade the earnings and the data that's coming at us.
You stripped down the muscle of big cap tech on the S&P 500, equal weight, Q2, down 3.1%. Market cap weight, S&P 500 Q2 of 3.9%. That's a massive outperformance there.
At a time when a lot of people are wondering whether we're overpricing some of the earnings at some of the top companies. This from Torsten Slok that I thought was fascinating. The top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of earnings. This is gaming out ongoing gangbusters types of growth from the likes of NVIDIA.
Marvin Lowe, it's good to see you. Thank you, sir. Marvin Lowe there of State Street. Equity futures right now positive by 0.1% on the S&P. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu is vowing once again to continue fighting Hamas until the militant group is eliminated. He spoke after an Axios report claimed that the Biden administration sent around amended language for its ceasefire proposal between Israel and Hamas. That report also goes on to say that the U.S. is working with Qatari and Egyptian mediators to change what's in the first stage of a three-part deal. And we also got China data this morning. It was mixed and it continues to fuel worries about the country's economy. The Caixin manufacturing PMIs beat estimates and it had the strongest reading since 2021. But a gauge of manager expectations for output fell to the lowest since 2019. Chinese bond markets responded with a rally that sent yields to a record low. And the PBOC has pushed back and hinted that it might sell some of its own holdings. The DOJ has told Boeing that it's charging the plane maker with fraud in connection with 2 fatal crashes involving its 737 MAX plane. That leaves the company to choose between pleading guilty or taking the risk of going to a trial. The company has until the end of the week to make that decision. The DOJ has also told Boeing it will need to pay a fine and hire a corporate monitor. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the president fighting back.
I know how to do this job. things done. I know, like millions of Americans know, when you get knocked down, you get back up.
Very different President Biden at that campaign event. Much more on that story just around the corner from New York City this morning. Good morning. Live from New York, welcome to the program. Equity futures here positive by 0.1% on the S&P 500. In the bond market worldwide right now, yields drifting higher. Small move in the US, up a single basis point. The 10-year here, 440.79. Under surveillance this morning, the president fighting back.
I don't walk as easy as I used to. I don't speak as smoothly as I used to. I don't debate as well as I used to. But I know what I do know. I know how to tell the truth. I know how to do this job. I know how to get things done. And I know, like millions of Americans know, when you get knocked down, you get back up.
So here's the latest. Key Democrats rallying behind President Biden's re-election bid following a disastrous debate performance. Even as the latest polling from CBS shows just 27% of voters believe Biden has the mental and cognitive health to serve as president, down from 35%, already exceptionally low in early June. Terry Haines of Pangea Policy joins us now for more. Terry, I think you, sir, have been on the money. A lot of fake outrage over the weekend, obvious to everyone but pro-Biden media. Thursday evening seemed to be a wake-up call for those individuals. Terry, a question I'd ask to you, how much of this story is already in the price?
Well, I think probably most of it is, John. There's a lot of, in politics in America these days on both sides, there's an awful lot of shame, an awful lot of lack of humility to go around. But the voters were very much ahead of this as well. And thank you for the compliment to me, but this program was well ahead of this as well. But bottom line is the voters have been well ahead of this all along. And at the end of the day, what you're going to have is Biden still running, and you're still going to have a neck-and-neck race, I think. And that's where we are.
Terry, what are you learning from the polls that we got since Thursday evening going through the weekend?
Nothing so far. The usual rule of thumb on this, and it was applied during the State of the Union address, which I think is the last major public television event that was widely tuned into, is that it's going to take almost 10 days to fully shake out. It doesn't surprise me a bit that a flash poll of a bunch of folks says, wow, there's some more concern here. But at the same time, I think what you're going to have is you're going to have a Biden rescue effort going on over the next 7 to 10 days to try to mitigate that. And they also think, they've got 4 months to turn this around. I've said to you before, I'll say it again. It's not going to ever be a case about whether Biden makes the grade one time. He's going to have to make the grade every time between now and the election in order to put himself in the best position to win. Now he's starting off a little bit behind.
Terry, the New York Times, the Atlanta Journal-Constitution, a number of different newspapers have come out, their editorial pages saying, hey, Joe, step down. You should pave the way for somebody else. It's unusual to have this kind of groundswell of a response in media where the op-ed pages traditionally are known as skewing to the liberal side. Do you think that is significant?
I think it's significant only in the sense that many of those same outlets are actually trying to cover their tracks on a lot of this stuff. They've been enablers for the president. They've among other things, derided reporting that Wall Street Journal and others called into question Biden's mental acuity and everything else. And the other shoe to drop from the New York Times in that very same editorial is, we think he should drop out, but if he stays in, we still think he's the better choice over Trump. Which tells you everything you need to know about what's actually going on there.
At the same time, a number of people are gaming out, including on Wall Street, the idea that Donald Trump now has a better chance of winning. I'm looking right now at Predicted. It gives Joe Biden about a 30% chance of winning, down from something like 46% just a couple of days ago. Do you agree that this is how much the odds have shifted against Joe Biden, given the performance of the debate and, frankly, the groundswell of outrage in his own party that he hasn't allowed someone younger and possibly more dynamic to take his place?
Absolutely not. I don't. I generally don't have much use for betting markets, but in this case, I have even less because, the president uniquely is not elected by a popular vote. The president is elected in the Electoral College. We all know this, and yet we want to go ascribe lots of significance to these things. Bottom line is today is that the Electoral College is where it was, which is an essentially even race with about 77 Electoral College votes up for grabs, the vast majority of which are skewing slightly to Trump today, but it's all still within the margin of error. So, that's a very different look for a president than a betting market. Number one. Number two, who the president is all by himself doesn't matter. When you have to mix in president with Congress in order to understand what's going to happen in 2025. If you do that, what you find out, I think, is that it's about 70% likely that you've got a split government in Washington, regardless of who the president is. So, betting markets and can move all over the place if they want. But I think that's actually the situation we're looking at today.
Terry, how do you think they're going to manage his campaign? We all remember 2020. He was able to make it a referendum on Donald Trump. He could sit back, some might say, hide away from the whole campaign. COVID was absolutely ripping through many economies worldwide. That meant he could take a real step back. He can't do that this time around. How does he prevent this becoming a referendum on him?
Well, I would say it's a referendum on him regardless. And I was saying that, I think, before the events of last week, because he's got to show that he's up to the job, and he's got to show that he's able to really talk about it and do more than just have the minimum acuity available. But now they're going to have to ramp that up. He's going to have to be out there a lot more the way he was the Friday and over the weekend. And I think what they're going to end up doing is putting him out there more. And, frankly, I think they have no choice but to do that, number one. Number two, they're still going to stick to this strategy of calling Donald Trump the lying liar. And, that's been evident in press both before and their own emails, both before and after the debate. What they think they've got there is a combination of convicted felon plus liar beats president with some concerns. The last thing I will say about this is this. Larry Sabato of the University of Virginia did some very good work last week before the debate, and showed that in people that are slightly for, slightly less. Slightly for Biden's presidency, Biden is plus 28 over Trump. People who are slightly against what Biden's been doing in his presidency were up by Biden over Trump by 77. And that's not a typo. The question is not in the electorate, is it Biden or Trump? Which in any other race it would be Biden versus the Republican. The Republican would be getting some benefits here. What this is Biden with an advantage among unsure voters, and those voters right now having nowhere else to go. So it's I think a very different race than most people are seeing.
Terry, just quickly, when you say the answer is to put him out there more, what do you mean by that? Scripted rallies? Teleprompter? Are we talking about news conferences, actual sit-down interviews, much more frequency, seeing that a lot more?
Oh yeah, I think it's you're going to see the White House do what they've done before occasionally. You're going to see them put him into quote unquote candid environments, but they will try to, as they always do, to control that environment absolutely as much as possible. And they've as we talked about a little bit earlier, they've still got some willing people to help on that.
You just wonder if there is a second debate. Terry Haines of Pangea Policy. Terry, thank you, sir. Just to pick up on what Terry said at the start of this exchange, the general public had already seen what we'd already been talking about on this programme for the last 6 months, that the president wasn't in a great state. You can see it in the polls. This was June. Does the president have the mental and cognitive health to serve as president? 35% said he did. The update is 27%.
The issue to me is what went wrong, where all of these people were in denial and didn't address this when there still was time left on the clock. And is it just too late? And ultimately, is that what we're seeing right now in the reluctance to move on?
Global politics in focus this morning. Up next on the programme, Marine Le Pen's national rally dominating the opening round of voting in French elections. That conversation is up next. Hello Q3 and welcome to July. Your equity market looks like this on the first trading day. Equity futures positive by 0.1% on the Nasdaq, totally unchanged on the Russell, positive a third. On the quarter though, and I think we need to talk about this a little bit more. The market cap weight, S&P 500 advancing almost 4%. The equal weight for Q2 down by more than 3%. Lisa, that's the story of the last quarter.
There raises it's an uncomfortable question, which is essentially if you don't see some sort of broadening out in this rally that everybody has been expecting, and it's been like waiting for Godot, it never actually happens. If you don't get it, is there a broader weakening type of signal that makes the rally that we're seeing unsustainable? That is the fear that you see embedded in a lot of the potential calls that we hear from Wall Street.
Just starting to see those cracks in the economic data, just slowly, particularly in the labour market. We'll see how this starts to infect markets more broadly. In the bond market, yields worldwide this morning shifting higher. We saw this Friday, double-digit basis point move on a 10-year yield to close out Q2 going into the weekend. Your 10-year resets this week at 441.18.
So you asked me earlier, what did you make of it? And if I were really honest, I would say there might be some kind of political overtone to it.
+1.
Exactly. There seems to be this issue that essentially, if you get the chance of a Donald Trump presidency, that could potentially be more inflationary in certain aspects and cause the Fed to have to counter that in some capacity. You can argue that's not true. I've seen arguments on both sides. Regardless, that is what's coming out in a lot of the Wall Street notes. And you have to wonder whether that did infect the bond market just a little bit on Friday at a time where otherwise you're not necessarily seeing the data to really support that.
I'm going to say it. Friday was the first trading day of this election campaign.
There you go.
It was day one.
Bold.
And I think it's backed up by what we're hearing from the South Side over the weekend, trade after trade. It's not scenario analysis anymore. It's actually people saying, you know what, the risks have gone up. This is what it looks like now.
And that was Matt Hornbach's point from Morgan Stanley, basically saying that if Donald Trump wins, and now there seems to be a greater chance in their eyes, you start to see that yield steepening, which essentially goes to this point that either candidate isn't going to counter the deficit. The question and the unknown is, what happens when you overlay tariffs and curb immigration to a great degree? How much does that shift the economic picture in ways that currently is not in the trajectory?
That's the politics of America. On the other side of the Atlantic, we need to talk about the other side of the trade. On euro-dollar, we need to talk about a single currency. The euro's firmer here by about 0.4% at 107.54. So the polls were saying one thing, and ultimately Marine Le Pen's party did quite well, but just not as well as the polls were suggesting. And now we face the scenario from round one to round two that you might get some tactical voting. Some of the people that are in third place drop out to try and form this sort of like unofficial coalition to prevent Marine Le Pen's party from going forward and getting a majority.
Basically, Macron's party and the Left Party are going to join forces to try to make sure that the Marine Le Pen party doesn't get some sort of majority. I take a look at this, and to me, the market question is, let's say that happens. All of a sudden, do French assets go back to where they were before? Was it as if the election never took place? Does it go back to sort of not having the same kind of risk premium baked in versus German benchmark yields? I don't know that that's the answer. I've seen a number of reports saying that basically that's what people are expecting to happen. But is that what we're doing here? We're papering over all of the political dissent and the potential populist upswing by just simply little votes that can just quiet it for a longer period of time? It's sort of what's been going on for a long time. When does that breaking point happen where suddenly this embeds something real in markets?
It's worth pointing out the spreads are narrower. France versus Germany this morning, but only because German yields are up more. It's not like French yields are down. We're up by 2 basis points at 332.
Yeah, in fairness, it's not as if Germany is just facing this complete political stasis. I mean, they are facing their own political unrest. At the same time, you have to wonder whether that gap stays wide, as some people were expecting, or whether it just goes back to what it was before, if there is some coalition between the Macron party and the left.
Much more on France in just a moment. Under surveillance this morning, President Biden's campaign fighting back in the face of rising doubts over his ability to serve. The latest CBS News poll finding 27% of voters believe he has the cognitive health to serve as president. That's down from 35% a month ago. Far more instructive to me is the 35 than the 27. I'll tell you why. If you were surprised by Thursday night, where have you been? 35% of the electorate, they're basically already saying that this is a big problem.
And the fact that it hasn't been addressed earlier is also a big problem. Why is it that there is a cadre of Democrats around Joe Biden that haven't been discussing this actively in public and acknowledging what everyone else is seeing? I'll add another twist to this that we haven't mentioned this morning. What about the adversaries of the United States that have been watching this? We heard concerns quietly by European leaders who saw Joe Biden on some of the trips saying that they were worried about him. Now you have Netanyahu. You can have very controversial figure both within Israel and outside, and a lot of people usual, not a fan. That said, he's raising the specter of an emboldened Iran as a result of the speech and the debate that Joe Biden put on. And this concern of who is running the country if he's not capable of really being with it after a certain hour. These are some of the questions that are percolating. It just is difficult to see how this is going to increase the stability of the world, let alone the country.
They're legitimate questions. This is a question that's not going to go away. Certainly not this morning. We'll be covering it for you over the next few weeks, months, and maybe a lot longer than that. The DOJ elsewhere telling Boeing that it's charging the plane maker with fraud in connection with 2 fatal crashes involving its 737 MAX planes. This is according to our reporting here at Bloomberg. The company has until the end of the week to decide whether to plead guilty, with the DOJ also telling Boeing it will need to pay a fine and hire a corporate monitor. Lisa, that stock is down 1.2%.
If they get this fine, it would essentially bring the penalties around some of these incidents to around $500 million. The fact that Boeing shares are only down 1.2% shows how much pain has already been baked into these shares. It's one bad news after another, and it seems like the Department of Justice can't let this go. Just from a sort of moral and legal perspective, as much as this is the national champion that they need to see financially succeed, they have to take actions at a time where a lot of people are raising questions about, frankly, the safety of their planes and just the oversight by U.S. government officials.
Are you checking the plane before you board?
I'm not, and I'll tell you why.
Go on.
I don't want to know. Because I'm not going to get off the plane. I mean, I know myself. I don't want to know. I'm like going to do the ostrich mentality.
Yeah.
Full on, just denial, stick my head in the sand, pray for the best.
I would do the same thing. Because I'm not going to change, but it would just make me anxious. But the fact that it would make me anxious is a problem for the manufacturer.
Correct.
Clearly.
Yes, that's the reason why I'm not going to check.
Okay.
No, I don't care.
George Ferguson of Bloomberg Intelligence joining us a little bit later this morning. Look out for that exchange on Boeing. Let's get to this final story. Marine Le Pen's national rally dominating the first round of voting in French legislative elections, locking up just over 33% of the vote. This according to Interior Ministry figures. The new Popular Front got 28%, while Emmanuel Macron's coalition picked up 20.8% of the vote. On the ground in Paris is Bloomberg's Caroline Conan. Caroline, this was round 1. Walk us through how we're set up for round 2.
The relief could actually be short-lived because it's going to be quite intense campaigning between today and the second round on Sunday, July 7. A lot will depend on alliances between the two rounds because usually a lot of the time you have duels, 2 candidates facing each other in the runoff. But in this case, because of the high participation that was at the highest level in 3 decades, you have in more than half of the constituencies across the country, you have 3-way contests. So a lot will depend on how many candidates who came in 3rd position actually pull out of the race and decide to block the national rally in the second round of these elections. Already the far left and the socialist moderate left wing have called for all those who came 3rd to withdraw from the race. It's a little unclear for some of Macron's candidates whether they will pull out. We will know by 6 p.m. French time tomorrow, Tuesday, who remains. But clearly, calling for this snap election, this is a strategy that could backfire for Emmanuel Macron.
How comfortable is the alliance from the left, from the progressive parties and Emmanuel Macron's party? Do we see that as something that has a lasting effect to try to keep Marine Le Pen from attaining the power that it seems like is there in terms of the polls?
This is actually a very interesting question because a lot of people here, analysts, actually are saying that this union of the left, the new Popular Front, could actually implode and the far left could potentially be sidelined. That would be a way for President Macron to find some kind of fragile new majority with the moderates from the right, the moderate from the left. Even if it means possibly a technocratic government like we had a few years ago in Italy, for example, with Mario Draghi. Now, there is still also a slight chance of an absolute majority of the national rally. At the moment, 2 polls are actually saying that Marine Le Pen's party could indeed get an outright majority, and in that case, you get Jordan Bardella as prime minister, and you end up in what we call here a cohabitation, where you have to share power with President Macron.
Watch this space. Caroline, thank you. Caroline Conan in Paris on the ground after round 1, looking ahead to round 2. Joining us now to talk about the market consequences, Pooja Kumra, the European and UK rates senior strategist at TD. Pooja, what are you telling clients this morning after those results over the weekend?
Thank you. I don't think we are any more knowledgeable after the results that we got through. I mean, they were exactly what we saw in the election polls, and that's why you are seeing French versus Bund spreads actually tightening. It's not that we are actually excited about the results. I think as something that you were mentioning, I think it's all about this round two that we are going into, and what we think in terms of what could happen is a hung parliament with an RN majority or an absolute RN majority, or a hung parliament which has a very bad split with the three parties. Our base case is still for a hung parliament which has RN as the main leading bloc, which would actually see a cohabitation government, which we just mentioned. But I think coming back to what it means for the rate space, I mean, 10-year OATs versus Bunds are actually around 75. This compares to something like 45 basis points that we saw ahead of the elections. Are we getting back there? I don't think so, no matter what the scenario is. I think we will be around the 60 to 70 basis points range here. What markets need to know is that what exactly comes in terms of fiscal, and that's likely to be in September, when all the countries will have to submit their budget plans to the European Commission. And that's also when you could see more rating reviews actually happening for France and all the French-linked assets. So I think that is the next key big thing for Europe. And the uncertainty is likely to maintain. But I think as we head towards September, focus will be more on the US fiscal versus the French fiscal.
Pooja, I'm wondering at this point, is France alone? Right? I mean, is France the outlier here, or is it kind of one of the leaders? I mean, you're looking at Italy, then you're looking at France, you're looking at this upswing of the far right in Germany as well. How much is this sort of what will become the status quo in Europe that's going to really affect the rates market of a host of other European nations?
No, that's a great question, especially the results in France as well as Germany, as you mentioned, have been pretty shocking. But I think if you look at the European parliamentary elections as a whole, the entire move towards right wasn't that extreme as compared to France and Germany. So it was basically a 4 to 5% shift. But we also need to see, what does the new right mean? Like Italy's Meloni has done a great job representing the new right, and they are no longer that extreme. And I think that is particularly driven by the fact that everyone takes Liz Truss an example. And I think that's why, UK election is getting no traction, because everyone is so scared on going big on fiscal. So yes, we are shifting. I think primarily because everyone wants a change, but they still want very centrist view. And the new right in Europe is more towards the center. Again, we need to see how Le Pen plays it, but so far her views have not been as extreme.
Pooja, there's a problem in Europe when we start talking about acronyms at the ECB. TPI, Transmission Protection Instrument. What would activate that kind of action from the ECB? If it's not 80 basis points of spread between France and Germany, what is it?
So I mean, if we do see the spreads actually going above 100 basis points, yes, the TPI could be activated. But just to give you some background on TPI, France needs to abide by fiscal rules to actually use this tool, to get the benefits of this tool. So if Le Pen, for example, comes back to her plans of spending that we saw in 2019, I don't think ECB will be ready to actually support OAT spreads here. So I think that is something that even France knows, that if it wants to benefit from, say, the NGO money that it's getting in terms of loans and grants, or this TPI tool, what is required is actually abiding by the fiscal story.
Pooja Kumra of TD. Pooja, thank you. Something very, very European about this, uniquely European about this bond market development, right?
Well, essentially that you have to be appropriate, and if you're not appropriate, you're not going to be on the receiving end of some of these programs. So you have to be within our rules, and otherwise you don't get the benefits. At the same time, you wonder if things widen out enough, if they get the benefits anyway, because essentially they are here to close spreads.
It's amazing how the Liz Truss scare of the last couple of years seems to shape politicians, not just in the UK, but elsewhere too.
I'm glad you picked up on that. I wonder the degree to which it will. And I think that this is a faith that's being baked into markets that we've been asking about for a couple of weeks. Is there some sort of market put on any of the fiscal proposals for whether it's Donald Trump or whether it's Le Pen? This is an ultimate question that we don't have an answer to, but it's a belief baked into markets that they will respond to a market tantrum.
Yields, spreads between Germany and France a little bit narrower this morning. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing has agreed to buy back supplier Spirit Aerosystems for $37.25 a share. It's an all-stock deal that values the company at $4.7 billion as Boeing looks to fix manufacturing defects. It also undoes a 2-decade separation of the two when Boeing in 2005 spun off Spirit as an attempt to trim costs and outsource assets. Now, as part of the current deal, rival Airbus will also take over parts of Spirit. That transaction is set to close in the middle of next year. Mercedes is boosting spending on gasoline engine models after first generation of EVs fell short. CEO Ola Kalania said that in an interview that it needs flexibility for longer into 2030s, but it will not impact the goal of going carbon neutral by 2039. EV demand has slowed in Europe, where BMW is also facing similar issues. They also face the threat of cheaper Chinese EVs, even with new tariffs in place. And England somehow snuck through to the quarterfinals of Euros 2024 with a 2-win nail-biter win over Slovakia yesterday. England trailed for much of the match against the 45th ranked team, but a last-minute equalizer, an over-the-head equalizer, I should add, from Jude Bellingham sent the match to extra time before Harry Kane found the decisive goal for England. They'll now meet Switzerland in the next round. Spain will meet host Germany after their 4-1 win over Georgia. In today's matches, France takes on Belgium and Portugal, Slovenia. And that's your brief, John.
Danny, thank you. Just a ridiculous weekend of sport. And more to come. Up next on the programme, stuck in the rearview mirror.
I do worry that the more likely error right now is that the Fed will not start cutting early enough and then will be forced into cutting aggressively. A forward-looking Fed would certainly have the possibility of a July cut on the table.
Much more on that analysis in just a moment. From New York City, you're watching Bloomberg Surveillance. Kicking off Q3 in a brand new trading week with stocks just about positive by 0.1% on the S&P. Bond yields a little bit higher, just a single basis point on a 10-year in the US, 440.99. Under surveillance this morning, stuck in the rearview mirror.
I do worry that the more likely error right now is that the Fed will not start cutting early enough and then will be forced into cutting aggressively, but it's not going to have the impact in terms of slowing or moderating the slowdown, and then will overshoot on the way down yet again. A forward-looking Fed would certainly have the possibility of a July cut on the table.
So here's the latest. Investors looking ahead to a busy week, headlined by comments from Fed Chair Jay Powell tomorrow and the US jobs report on Friday. Michael Darda of Roth MKM writing this: the hallmark of good central banking is to try to be forward-looking so that the slippage between the neutral rate and the policy rate is kept to a minimum. Reacting belatedly is nothing more than a setup for a rinse and repeat, boom to bust set of cycles. Michael joins us now for more. Michael, wonderful to catch up with you, buddy. You're one of the very best working out where we are in these cycles. Can you tell me what's flashing red on your dashboard right now? What is it?
Thank you guys for having me on. I appreciate it. Well, look, I actually just took a look at the Bloomberg Surprise Index, so I'll give you guys that prop. It's rolling over, right? We've had a raft of pretty weak data. We're going to get some additional manufacturing figures this morning, but housing's been rolling over. We're starting to see some upward pressure on jobless claims. First-time claims still look pretty healthy, but continuing claims are actually about 35% off the lows of the cycle. And despite pretty strong headline payroll growth, the unemployment rate is moving up. It hasn't jumped drastically, but we're 0.6 off the lows. And if you go back historically, it's very unlikely that you see something like that without the beginning of a recession not far off, or actually, in it, and you don't realize it. And so I agree with the quote from Mohammed that you played earlier. I think that the risk here is because the Fed is dealing with the aftermath of this 2-year inflation overshoot, once bitten, twice shy. Most likely, I think they're going to be a bit late and a bit behind the curve here.
Michael, when clients say we're just normalizing, that's all this is. We're just normalizing. It's nothing worse than that. How do you counter that point?
Yeah, well, I think it really, normal depends on the state of the business cycle. And so the first mistake the Fed made, I think, was a bit of a primacy recency bias. So the previous cycle was very low inflation, very low growth, in a long period of very low rates. And so the Fed really acted aggressively. Fiscal policy was much more aggressive. And no one wanted to believe that we were in a V-shaped recovery with high inflation. So it took a while for the Fed to acknowledge that, and they were way behind the curve. And so normalizing meant raising rates much more and then holding them higher. And now things are decelerating. We haven't totally fallen off a cliff just yet. But if the cycle continues to weaken and the Fed is just standing pat, then you have essentially a passive tightening in monetary conditions. And that's the end of the cycle. So business cycles don't last forever. And the reason for that is it's very difficult for the Fed to be precise in tracking the neutral interest rate. And Powell talked about this in the last press conference. So normal is very much a relative term. It depends on the state of the business cycle. So, 5.25% to 5.5% policy rates, a year ago may have been appropriate. But moving into the fall, that might be much too high for the state of the labor market.
Given all of that, and given the data that we have coming out this week, what's the most important that you're looking at to really gauge how urgent the Fed should feel about cutting rates?
Yeah, I think the labor market data on Friday should be interesting, and whether we end up seeing this divergence between the two labor market surveys being resolved, anytime soon. So the unemployment rate comes from a separate survey of households. It's generally viewed as not as reliable, but it does tend to move at turning points. And the unemployment rate itself is really only revised once. So as a singular summary statistic, I think it's a super robust, coincident to slightly lagging indicator, and can at least confirm what's happening to the business cycle. Are you growing at trend, above trend, below trend? If the unemployment rate is inching higher, that's a very strong signal that the economy potentially is, if it is growing below the growth rate of potential. And so that should potentially be setting off some alarm bells at the Federal Reserve. And, they are watching it, but, other data has looked more robust. So there's a debate going on.
Mike, what's the signal for markets right now? We talk about the divergence between the benchmark index level, the S&P, up almost 4% in the second quarter, even though equal weight was down about 3%. Is this a feature of the market strength or a bug of that market strength?
Well, I think it's both. It's a feature of the AI frenzy. So the S&P 500 has had just tremendous gains, and those have been driven essentially by 6 or 7 stocks in 2 sectors. On a year-to-date basis, the small caps are sucking wind, transports are weak, and so those areas might tell us more about the state of the U.S. business cycle than what's happening with the S&P 500, which is so AI driven at the moment. And so it is an interesting divergence. The transports have been underperforming the S&P 500 in a way that you see at the end of business cycles. And so that's definitely something to keep an eye on. If we can think in a multi-year, over a multi-year horizon, few can do that. But, I think some of these areas that have lagged, in particular the small caps, I do think if we're thinking in a 5 or a 10-year framework, I think there's more upside there than maybe some of the areas that have performed so well. And I'm not saying, step out there and start shorting tech stocks today. Anyone who's tried to do that has been totally run over. So, a frenzy, the old quote is they go much further than you think, but they don't correct by going sideways. So, dangerous game there. But I think if we're thinking longer term, we probably have to pull in the expectations for the S&P 500 and then maybe be a bit more optimistic about some of the areas that have lagged.
I was going to say that's what we call a trade for the brave. Michael Darda of Roth MKM. Mike, good to catch up, sir. Thank you. Chairman Powell speaking tomorrow, July 31, the next Fed decision. Then you've got to wait to September 18th. Yeah. You get some forecasts, new projections. Jackson Hole in between is September, the one people are focused on now.
Yeah, maybe we should just join Michael Darda with his surfing poster in the background. I kind of want to go where he's going.
See that Tom Hanks movie in the background too?
Well, that movie, The Endless Summer, documentary about surfing. Highly recommend.
after 2 years of essentially no earnings growth, we are back to an earnings growth pattern.
I think you have to play the game. A momentum market is not one to stand in front of. It's like standing in front of a freight train.
That kind of weakness under the surface breeds opportunity. So when you have that poor breadth, at some point, you start to see an improvement.
That will, I think, happen. What goes up will come down, and there will be mean reversion.
When does the breadth change? When does things broaden out? And what we think is it has to get worse before it gets better.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Hello, Q3. Live from New York City this morning. The second hour of Bloomberg Surveillance begins right now, with equity futures positive by 0.2% on the S&P 500. Payrolls on Friday. Next Thursday, CPI. Stuart Kaiser of Citi with this to say: payrolls more important than CPI in July.
I would agree with that statement, just simply because we've seen the Federal Reserve shift their focus to potential weakening in the labor market. And it seems on the pendulum of Fed priorities, the idea of labor, the idea of jobs is more important right now than CPI that's coming down but hasn't reached their target just yet.
And within the payrolls report, is the unemployment rate on Friday more important than the headline number? The headline number on Friday, 190. The unemployment rate, 4%. If that keeps drifting, does the Fed have to move?
Two things that are going to be important. Understanding whether we get some sort of merging of these two surveys that have been incredibly different in terms of the households versus the overall payrolls. There are others. The other question here is, to your point, the idea of what kind of unemployment rate we see at a time where it's unclear how many jobs need to get created every single month to just have an equilibrium in an economy that really has changed and in labor dynamic that has really become quite different.
This is the first trading day of Q3. We're making a case on this program that Friday was the first trading day of the campaign, the election campaign for 2024. Yields started to break out. You started to see more notes from a lot of individuals on the South side talking up various trades connected with a Trump win.
Terry Haines shrugged off the idea of prediction markets, shrugged off the fact that people are gaming out a much higher likelihood of Donald Trump actually winning the presidency, saying it comes down to the Electoral College, et cetera, et cetera. Nonetheless, Wall Street analyst notes seem to also agree that on the margins, Donald Trump had a better chance of becoming president after the debate that we saw on Thursday night, at a time when a groundswell of Democratic voices are calling on Joe Biden to step out of the race and allow someone to take his place. We're running out of time for that to happen. So the real question here is, if he stays in, what does that do to the election? What does that do on the international stage at a time where a lot of people are watching?
None of this is straightforward. If you ask the former president if he was pro-growth, he'd say without a doubt this would be a pro-growth presidency. If you ask the research divisions of certain banks this morning, Morgan Stanley, they might come up with a different answer. Mike Wilson saying risks are skewed to the downside for growth under Republican win scenarios due in part to immigration reform and tariffs.
Well, I mean, just think about what people have been saying. The reason why we've seen labor market growth and, frankly, a labor market that's allowed this kind of job creation without an increase in wages is because of immigration. And you could say whatever you want in the political sphere, but that has been one of the main driving thoughts of a lot of different research pieces. So here's the question. If Donald Trump is serious about curtailing and possibly even deporting certain people who have come to this country, what does that do to the labor market? What does that do to the potential productivity? Putting that aside, what does it do with tariffs? And then this ultimate question of, is the former president going to be checked by a market that might sell off in response to that? A lot of uncertainty.
And somewhere in between, somehow, the chairman of the Federal Reserve has got to set monetary policy for everything you just described. There's a lot of work to do. Equity futures right now on the S&P positive by 0.2%. Bond yields shifting higher worldwide, actually, this morning, following the sell-off on Friday in the Treasury market. Yields up just a little bit this morning by a single basis point at 440.99. In the FX market, the euro stronger, Lisa, after round one of the elections in France.
Evidently, Marine Le Pen didn't win by as much as some people previously thought. And the bigger issue to me is this idea that there could be some sort of coalition, loose kind of allegiance between the left party, the progressive wing, and Emmanuel Macron's party that could potentially limit the control that Marine Le Pen has after the second round next weekend.
Spreads narrower. The euro stronger, French equities rallying. That's just Monday morning. We'll see what the week brings. Elsewhere, coming up on this programme, we'll catch up with David Kelly of JPMorgan as stocks kick off the second half of the year. Ed Mills of Raymond James as Biden loyalists defend his campaign. And Krishna Memani of Lafayette College on the bond market risks of another Trump presidency. We begin with our top story. Stocks looking to keep up momentum in the second half after gaining almost 15% this year. JPMorgan's David Kelly writing this. Neither consumers nor investors are behaving as if they are scared. Investors have pushed the S&P 500 to an all-time record high 33 times already this year, while consumers have maintained a personal savings rate of 3.6%. David is with us around the table. David, good morning to you.
Morning.
A lot of people coming on the programme talking up a consumer slowdown, cracks in the labour market. Why shouldn't we be fearful of that?
I don't think we should be fearful right now. What we're seeing is a small downshift in growth. We have a problem at the lower and middle income consumers. And if you look at consumer non-durable spending, things like food and clothing, just the basics, that was actually lower in May than it was in December. So we can see that slow down. But at the same time, we've seen tremendous wealth gains. And we've also seen tremendous wealth gains. We've seen a lot of payroll job growth, a lot of wage income growth. So as I look at the consumer spending will grow more slowly, somewhere in the 1.5% range going forward for the rest of this year, as opposed to 2% plus. But that's still enough. And so I think all that's happening here is the economy is slowing down to a little under 2 in terms of growth, a little over 2 in terms of inflation, but it's still pretty good.
So slowing, not slow. Can you tell me the difference between normalisation and something more sinister? What would that look like? What would change your mind ultimately?
Well, this is a very stable sort of. It's kind of like this very stable machine that sort of just pumps out twos in terms of growth and inflation. What could change that is something will change it. A shock, or B, a big policy change. We were just talking about I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. If Joe Biden is the candidate, it's quite possible a lot of independents will stay at home, and so Republicans will sweep. Now, if they sweep, if you take Donald Trump at his word, you've got much higher tariffs. And now tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time. If you took him at his word on immigration, the economy would come to a halt because of deportation of unregistered immigrants or illegal immigrants. So, but I'm not sure if we can take him at his word. I think history suggests that perhaps it would be optimistic or not optimistic, but it would be foolish to take him at his word in this stuff. But still, it's something to think about. I mean, some policy shock could absolutely tip this economy into recession.
Hold on a second. John said that basically Friday was the first day of this election cycle, at least for markets. How much do you actually rearrange what you think about how to position markets as a response to this idea that you think that there is a greater likelihood of a Republican sweep?
It does make a difference. I mean, let me give you one example. The 2017 tax cuts. If Joe Biden is reelected, then some of those tax cuts will be extended beyond 25, but not all of them. If Donald Trump is elected, I expect that whole thing to go through. And if you add that to what the CBO is already looking at in terms of the growth in the debt as a share of GDP, by the early 2030s is going to be about 135% as opposed to 122%. So you're going to have significantly more debt if we extend all these tax cuts, and that means a higher level of long-term interest rates.
So in other words, are you more bearish on long-term bonds right now than you were, say, Thursday morning?
Yes, I think it would be a rational thing to be that way. Yes.
Let's build on that a little bit more. If that's how you've responded to Thursday night, how should Chairman Powell respond to this? Because surely he has to factor this into the equations for monetary policy looking out 12 months and beyond.
No, I think that to be honest, I think that's too cute. I think he should make policy for the economy that he's got because I think we can change our views a little bit here, but he always sort of takes monetary policy as given. Right now, markets are pricing in about a 70% shot of a rate cut in September, and I think that still makes sense because what I'm saying earlier on about a downshift in growth is real. That's what we've got right now. What happens after the election, does depend on how policies are implemented, but he can't really make policy based on how the election might turn out and then what a particular configuration Washington might mean for policy. It was just too far down the road.
Can we think back to 2017 when we got those tax cuts from the Trump presidency at the time? How the chairman of the Federal Reserve at that point, how the Federal Reserve adapted, given they had to wait for the policy, they had to wait for it to be delivered, and they had to wait and see what ultimately it would do to the economy.
Well, they were also getting a lot of incoming from the administration, which is very unusual. But the administration was trying to bully them into easy monetary policy, and we did actually end up in 2019 with very easy monetary policy, given an economy in which inflation was actually beginning to build. So, I mean, I think there's a real question again. If Donald Trump is elected and he has a Republican Senate, does he simply, does he want to replace Chairman Powell? And it's I'm not a psychologist here. It's a real question what the priorities would be for Donald Trump if he found himself in the White House again.
There's another question on top of all of this, which is just how much leverage the next president's going to have with respect to pushing different levers, given the economic fragilities that we started this conversation talking about. We began by talking about the second quarter and whether the idea of the underperformance of the equal weight, the underperformance of the Russell 2000 was a sign, almost a canary in the coal mine of some kind of weakness under the hood that is pervasive and that really is on a tipping point. Do you believe that to be the case? What would you have to see this week in the data coming out to give you that kind of sense?
No, I don't think so. I mean, I don't expect to see very rational signals coming out of the markets, to be honest. I mean, to me, when I look at the concentration in the US equity market, it speaks to the euphoria at the top, not rational thought at the bottom. I mean, I think that's what's going on. And if you look at the US share of global equity markets, the same thing. The US should not be 65% of global stock market cap. So when I see these things in markets, it doesn't tell me that markets are rationally discounting an oncoming economic slowdown. What it tells me is that people are simply doubling down on existing bets because they think this party's going to keep going.
Just to sort of put this all together, do you believe that some people are investing in big tech simply because they have all of this uncertainty, including the election coming down the pike, including the sort of uncertainty around the economy, that the one haven has been these tech names that keeps delivering, and that if we get certainty, that could actually encourage people to leave those names and go elsewhere?
We were talking earlier on about our granddaughter, and we took her out to the park recently to blow, and she was blowing bubbles for the first time, but it didn't work very well because it was really windy and all the bubbles were bursting. But if you had a really calm day, bubbles grow great. And the problem is we've got a really calm economy that just grows bubbles. What's happening is people look at the economy and say, that's fine. And then they double down on the bet on mega cap tech. They double down on the bet on the US. None of these bets are going to get reversed until something shocks the system. And right now, the economic climate's just too calm.
We'll see if November provides that shock. David Kelly, it's good to see you. Thank you, sir. David Kelly at JPMorgan. You just heard it again there, Lisa. Just on the margin there, just the changes that people are starting to think of after Thursday night.
It sounds like you were correct by saying that Friday was kind of day one of this election cycle and that people were rethinking a playbook for Donald Trump to win the election.
At least the first trading day, that's for sure. This is the first trading day of Q3, and we've got equity futures up by about 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Sticking with politics, President Biden is asking donors to stay following last week's disastrous debate. Biden told the crowd at a Hamptons fundraiser that he did lose a step on the debate stage and vowed to work harder. He added that he wouldn't be running if he didn't believe he could win. Biden's Thursday night performance does risk his ability to fundraise as much as Trump, to which the campaign has downplayed those concerns, saying it raised $27 million between debate day and Friday evening. Shares of Chewy surging more than 15.5% in the pre-market. Meme stock investor Keith Gill, a.k.a. Roaring Kitty, disclosed a 6.6 passive stake in the online pet product retailer. That's about $255 million. Both Chewy and Petco had briefly soared last week after Gill posted just a cartoon image of a dog on X. Now, the founder of Chewy, Ryan Cohen, had also been heavily involved in the meme trading frenzy, buying up large sums of GameStop until eventually becoming its CEO last year. Now, people familiar with the matter say that the DOJ has told Boeing that it's charging the plane maker with fraud in connection with two fatal crashes involving the 737 MAX planes. That leaves the company to choose between pleading guilty or taking the risk of going to trial. The company has until the end of the week to make that decision. The DOJ has also told Boeing it will need to pay a fine and hire a corporate monitor. And that's your brief, John.
Danny, thank you. We'll catch up with Danny again in about 30 minutes' time. Up next on the programme, President Biden's path forward.
He should stay in this race. He should demonstrate it going forward, his capacity to lead the country.
A rallying cry around the sitting president. That conversation up next, live from New York City this morning. Good morning. The equity market just about positive here by, let's call it 0.25% on the S&P 500. In the bond market, Treasuries a little bit lower, yields a little bit higher by a single basis point on a 10-year, 440.99. Lots of talk about round one of the French elections. The euro stronger by a third of 1%, 107.48. Under surveillance this morning, President Biden's path forward.
Joe Biden is the nominee, and I'm going to do everything I can to make sure we elect Joe Biden and Kamala Harris come November.
He should stay in this race. He should demonstrate it going forward, his capacity to lead the country.
Joe Biden is not going to take himself out of this race, nor should he.
It's the latest this morning. President Biden's supporters defending his campaign after last week's disappointing debate performance. Concerns about Biden's candidacy are growing. According to a new poll from CBS YouGov, only 28% of registered voters think Biden should be running. Ed Mills of Raymond James writing this. There is concern among Democrats that Biden will lose. But Team Biden is trying to argue that polling suggests he's still the best person to beat former President Donald Trump. Ed Mills joins us now for more. Ed, the question of Friday morning, Thursday night, we're still asking this Monday morning. How does Thursday evening change this race?
You know, it was a game changer. And what I've been looking at here, John, is that, you know, in D.C., people with power like to keep power. And that's on a collision course right now. It is very clear that Joe Biden and his team want him to be the nominee. He has enough delegates to become nominee. And so if he stays in this race, he will be the nominee. However, what I was talking about there is that other Democrats are really concerned about losing to Donald Trump and are really concerned about losing the House of Representatives in the Senate majority. If there were to be a Republican sweep, huge policy and market implications. And so the people who have power in Congress, those other elected Democrats, are really concerned that Donald Trump not only could be reelected, but there is an increasing likelihood of that Republican sweep. And so that collision course is going to play itself out throughout this month.
Ed, let's pick up on your point in that quote that I shared, that the president and the team around him are trying to argue that he's still the best person to beat the former president, Donald Trump. Does the polling still back that up?
The polling prior to the debate absolutely does. We're starting to get some polls out, some that didn't show that much of a change. But if the polling situation for President Biden starts to deteriorate, look for those voices to grow louder. One thing I say about D.C. very frequently is things are impossible right up until the moment's inevitable. So if we still get more polling out there that suggests that he could beat Donald Trump, then the Biden team is going to keep him in this race. But if his polling position deteriorates, that's where that swell from other elected Democrats come in and try to find him a graceful exit.
Ed, some people are calling him Joe Bader Ginsburg. There's clearly a real anxiety under the hood here about what happens if he stays in beyond that. Is there a deadline where he cannot choose somebody else, where he cannot step down because the ballots are printed, because the election has just gotten too far underway?
So I think a lot of people are looking at the deadline of the convention. I'm looking at an earlier deadline, Lisa, because I am looking at the fact that Ohio, you need to have a virtual convention to select the nominee, to have a presidential candidate for Democrats on that ballot. And if there's no Democratic candidate on the ballot in Ohio, not only do you give away those electoral college votes that more likely than not are going to former President Trump, but there is a key Senate seat that is key to keeping the majority in the Senate for Democrats. So that deadline's August 7th, before the convention. After the convention, if there is an emergency, you can have a meeting of the executive committee of the Democratic National Committee to select a new candidate. But because this is so out in front now, that gets much more difficult later on. This is a democracy. The people are supposed to have a choice in who the candidates for president are.
Ed, you started out by saying that it really was a game changer last week, and that certainly you're seeing that in a lot of Wall Street notes where people are saying, well, we have to game out what a Donald Trump presidency number 2 would look like in terms of the deficit, in terms of growth. Do you agree that there will be some sort of check on any sort of Republican sweep in the policies that ensue by a market that could potentially get spooked, whether it's yields going up significantly or whether it's certain more immigration-sensitive sectors getting hit harder in the stock market?
So, yeah, I was in Europe meeting with clients all last week. And one of the first questions was, is the policies that Donald Trump would be pursuing Are they inflationary? Would that be the second wave of inflation? When we look at almost $5 trillion worth of tax cuts, we look at an immigration policy that could impact labor force. There might be a lot of popular support for this, but then you add on tariffs, an immediate trade fight to restart with China, a trade fight with Europe. Obviously, the clients in Europe were very concerned with that. But that's against the reality of there's sometimes what you want to do in life and what you can do in life. And there's a lot of questions out there. Does the United States get a UK Liz Truss moment where you want to extend out $4.6 trillion worth of tax cuts, but the bond market does not let you do that? And so people that I'm talking to and all the clients at Raymond James are preparing for some of those contingencies if there were to be a spike in yield after this election.
Ed, forgive me for being the guy who's about to change the subject, but I'm about to change the subject. What got lost completely going into the weekend with the decisions from the Supreme Court? Can you walk us through just what you think we should be focusing on and how much has changed?
Yeah, so I think the other game changer from last week was the Supreme Court decision on Chevron deference. It's a thing that gets batted around, but the Chevron deference is what has allowed regulators here in the United States to basically decide what Congress made as a law. All the ambiguity, kind of the deference went to the regulator. That's gone. And so going forward, the deference is going to be to the business community very frequently and put pressure on Congress to clarify law. And so tech regulation, bank regulation, healthcare regulation, energy regulation, all of the work that the EPA does is now in doubt going forward. That's a fundamental shift to the regulatory state that has existed here in the United States, something that was the Friday news dump of all Friday news coming from the Supreme Court. So, John, thank you for changing the subject, because from a market perspective, if we look back to this last week, we probably will point to the Chevron change at the Supreme Court as the biggest long-term market mover.
Can we connect the two issues? Do you think that decision would pour gasoline over any Trump agenda?
Absolutely. If you look at potential deregulation, it's not only putting gasoline on a potential Trump or Republican agenda, it is also permanently impairing the ability of Democrats when they pass a new law in future governments for them to go and put forward new regulations. We think about tech. A lot of the tech regulations are on laws that pass before certain technology exists. So can the regulator regulate something that Congress didn't contemplate? That's so much in question right now. So either agenda, the regulatory state in this country has been ratcheted back because of that Supreme Court decision.
Absolutely fascinating. Ed Mills of Raymond James. Ed, thank you, sir. As always, Lisa, I know you've got thoughts.
Well, this to me actually was one of the biggest shifts, and you were so right to bring this up, given the fact that this basically undercuts regulators' ability to create rules for the energy industry, for the healthcare industry, for the insurance industry. Does this give a boost to those industries? Does this really undercut existing proposals? How much ongoing litigation will there be? To the tech point, that's fascinating at a time where people are really having a great deal of anxiety about how we're going to potentially regulate AI.
So much going on down in DC over the last week or so, that's for sure. Coming up on this programme, we'll turn to Tesla, preparing to report second quarter deliveries. That conversation is just around the corner as we kick off Q3 with equities positive by 0.25% on the S&P. And Lisa, guest after guest, just starting to take a Trump presidency that much more seriously after Thursday night.
You can say whichever you want about the predicted polls and the idea of what we see out there, but it does seem like there is a shifting pendulum away from Joe Biden in the wake of his performance at that debate, and it is not something that people can ignore in the market.
Will this Treasury market regulate any particular ambitions of any particular government?
To me, that's one of the key questions. People believe that the ghost of the Liz Truss moment is going to come over and rule this market. Will it?
Yields up this morning by a couple of basis points. Live from New York City, this is Bloomberg. Stocks are positive on the S&P, on the Nasdaq across the board actually. On S&P 500 futures this morning, positive by 0.2%. Similar move on the Nasdaq 100 on the month. Let's go through the scores for the month of June. S&P 500 up about 3.5%. Nasdaq up by more than 6%. Equal weight S&P down on the month. That underperformance, Lisa, on the month, on the quarter, humongous.
And it's one of the biggest divergences that we've seen going back to the 1990s between equal weight and the market weight. What we can see right now is this question of how long can the Magnificent Seven continue to generate these kinds of returns. Take a look at this. 17% gains for the Magnificent Seven in the quarter. That really compares to NVIDIA with a 37% increase. These have been the powerhouses at a time where their revenue is not quite keeping pace, and that's something that's making certainly Torsten stock a little bit queasy.
It wasn't always this way this year. You remember at the start of the year we were talking about the Mag 7 breaking down. The fabulous one, whatever you want to call it, just being NVIDIA. Apple started to struggle. Then that performance story just started to shift. Do you remember for a moment Alphabet was like done and dusted? It got everything wrong with AI, left for dead. Then Alphabet started to pick up too.
So there was this belief that they would be the most interest rate sensitive stocks. Remember that for a hot second, that they were going to be the ones that were curtailed if the Fed wasn't able to cut rates. That's been turned on its head as they're sort of independent of interest rates. And perversely, their cash piles actually give them a benefit from higher rates because they're generating an incredible amount of interest income from that cash. There is this issue of what could potentially sink these stocks, and it would have to be some sort of broad-based weakness. That, according to Mike Wilson, that maybe on the edges we're starting to see. It's unclear, though, and this is the reason why the week ahead is going to be important.
That's the stock market. Let's switch up the board and turn the page and get to the bond market. 2-year, 10-year, 30-year, looking a little something like this. Basis point higher on a 10-year to 441.18, up 2 basis points. On a 30-year, 457.55. At the front end of the yield curve, the 2-year at about 475.77. You talked about the week ahead, Lisa. We'll get into the details of what days bring what. But over the last month or so, just the labour market cracks, just starting to feed that conversation. And maybe this Federal Reserve chat of the last few weeks feels a bit stale.
And that's the reason why people think that Jay Powell, coming out tomorrow at the Sintra conference of the ECB in Portugal, is going to be more instructive than, say, the meeting minutes. Because when you take a look at the meeting minutes that come out from the FOMC's last meeting, to your point, they are stale. And it speaks to a very different tone that we've heard in the likes of Mary Daly and perhaps Fed Chair Powell, recognizing some of this weakness more than emphasizing the inflation rate.
The dollar coming off the back of 4 weeks of dollar strength. The euro showing a bit of strength this morning. Just a touch. We're up by a third of 1% against the US dollar. Stronger euro, 107.47 off the back of the results over the weekend in France. We'll talk about those results in just a moment. Under surveillance this morning, traders preparing for a busy week of economic data and a lot more Fed speak. US PMIs and Fed minutes coming before the latest payrolls report due out on Friday. And we'll hear from Fed Chair Jay Powell tomorrow. Wednesday is super busy. For a good reason, because we're all off on Thursday, at least most of us are. Wednesday means you'll get jobless claims. And I think jobless claims for a lot of people has been the one to watch.
I would completely agree with that. It's just slowly been creeping higher. And even though you see sort of a stability in terms of the initial jobless claims, continuing claims have crept that much higher. There's a feeling that there has been this steady weakening at a time where it's very unusual to see a linear move. We keep talking about this. Everyone's saying you're just repeating yourself. To me, it'll be key to see whether we see a breakdown in that in tandem with JOLTS, job openings coming out, and the ISM factors. Remember when we used to say, tertiary data. And then it comes out with a surprise to the downside, and suddenly people are wringing their hands and saying the sky is falling. We get ISM manufacturing today, and on Wednesday we get ISM services. If you have a 1-2 punch there, could that overwhelm some of the other data as possibly being a forward indicator?
2 economists this morning that I really respect, and you do too. MKM Partners, we've got the likes of Mike Darda. JPMorgan, we've got the likes of David Kelly. 2 completely different views on where we're going. Mike Darda's talking about this weakening, which the Fed has got to respond to. And David Kelly's talking about normalisation. We're slowing, but we're not slow. And it's OK where things are right now in the economy.
The tension to me, and we've talked about this extensively, is that there is a cohort of individuals, of households and of companies that are on the higher income level that are doing just fine, that are doing great, that are actually able to spend in significant portions, that are upholding the overall general economic activity. And then you have lower income households, more leveraged companies that are really struggling, and we see that in all of the data. How do you pair those two ideas? You can make an argument for a resilient, strong economy. You can make an argument for an economy that's falling off a cliff. Where does it come together in terms of Fed policy? And frankly, you can skew it however way you want. It is hard for me to understand how you put these two things together for a policymaker.
That's some of the week ahead for you. Let's talk about the last weekend. French President Emmanuel Macron's centrist alliance and his left-wing rivals are weighing whether to pull candidates from the second round of the election. This comes after Marine Le Pen's national rally dominated the first round of voting. This morning, let's bring up the spread. We can compare the French 10-year to the German 10-year. So you've got German 10-year yields higher this morning by 6 basis points. The French 10-year up only by a couple of basis points. The spread narrows. You can all see that based on the numbers. numbers. So the spread is in and around 75 to 80 basis points. OK, before this mess, it was about 40. You asked the right question. Whatever happens over the next week or so, do we go back to where we were before? And the answer we got earlier from TD was no.
And that's because you have this inherent risk that is implied by the groundswell of support from Marine Le Pen. How that factors out, though, is going to be interesting, and whether French is sort of a harbinger of what's to come in other governments, including in Germany, is a really important question at a time where people are seeing the same types of groundswells in populist sentiment elsewhere. And I think that's ultimately what we have to grapple with.
What's your response to the market reaction this morning off the back of the results over the weekend? What do you make of that?
Wishful thinking and people who are hoping for an opportunity to get in and get a discount. Didn't we hear that already? A lot of people saying that they were looking to opportunistically collect some extra basis points there.
Just not as good as it could have been for Le Pen. I think that's my only reaction to it. All of this sort of 3D, three-dimensional chess that people are playing about certain candidates pulling out, certain candidates kind of offering their support to another one to make sure that Marine Le Pen doesn't get in. The governance issues in France are not going to go away. They're going to get worse.
There was a quote by a former ambassador to France in the United States basically saying that the French nightmare is just beginning. And I think that that's a good way to characterize this.
I think a lot of people on board with that sentiment. Here's our next story. Tesla. Investors bracing for a crucial 6-week stretch. The company set to report second quarter deliveries tomorrow, ahead of earnings later this month, and its robo-taxi event in August. The stock is up in a pre-market by about 1.8%. Bloomberg's Craig Trudell joins us now for more. Craig, let's go through that 6-week stretch. What are you and the team focused on over the next 1 month, 2 months?
Well, it's pretty remarkable to see the stock moving the way it has just in the last week, 2 weeks, because we've seen just consistently analysts coming out and pairing their forecasts for vehicle deliveries for the second quarter. So the expectation pretty universally is that the company will have its second year-over-year decline. The last time that they had back-to-back quarters where they were down was in 2012 when they were phasing out the Roadster, their first vehicle ever. So you really have to go back a long ways, to find the last time that this growth company wasn't growing. And in spite of that trend, you're seeing sort of more emphasis, more focus on that August 8th date. The idea that Musk is going to sort of pull a rabbit out of a hat and unveil a robo-taxi, which I think there's, of course, reason to be, bullish on the business plan there, the prospects for that business, but actually executing it has been another matter for every company that's tried to bring one of those to market.
Greg, give us some more color on that. August 8th has been circled on the calendar since early April. This has been the carrot over the stock ever since, that we'll get this big announcement. Where is the bar? Where are expectations, and how much caution should we have?
I think that is the sort of big question here, because whether or not you can bring out a robo-taxi that is able to generate any revenue, any meaningful revenue anytime soon is really going to be crucial, because you can put a vehicle on a stage for people, get people excited about something new. Potentially assuage some concerns about the idea that you're not going to have a cheaper model to offer for some time. There's been a lot of concern about whether or not this robo-taxi has taken precedence over a Model 2, as people refer to it. If you can pair a sort of years out prospect with a more here and now cheaper vehicle, I think that is what the street would generally like to hear from Elon Musk at this point.
We haven't heard that much from Elon Musk in terms of his traditional role as a lightning rod for a host of different things. Is that by design, or is that just because he's been so busy with some of the issues that he's been facing, particularly in Tesla?
I mean, he's posting on X, tens of times a day. I do think that, maybe the number of them that have made headlines like we got used to for a stretch maybe has dissipated somewhat, but he's weighing in on all sorts of topics, from surprising stances on climate change over the weekend, and sort of downplaying the extent to which there is a crisis, which has been something fairly consistent lately, and very contrary to what people were used to hearing from Musk for years. So I don't think he's necessarily shed his lightning rod status. It may just be the case that we're all a little bit tired of this at this point.
Well, I guess the logical question following that is, how much does this basically create sort of less noise around Elon Musk that has both supported and also created volatility in the Tesla stock?
I mean, I think to the extent that he can, stop stepping in it, essentially, I think it's for the best for the company. There was real concern about, whether or not his compensation package would be reapproved, and whether or not, if that vote did not go his way, would he walk? And I think there were, some folks who were sort of the view that, while that is an awful lot of money on the table there, he also, is still the biggest shareholder in this company. Do you really need to give him, $56 billion worth of stock options to keep him, motivated? Maybe not. And there are, some real questions about, just how much that was more of a symbolic vote than it is actually, of legal merit. And that will be another really important thing to watch in the coming weeks is, the Delaware Chancery Court and their, determination in terms of, what that vote meant, if anything, and where that fight goes next.
Craig, we've got a lot to talk about over the next 6 weeks. Looking forward to doing it with you. Craig Trudown there of Bloomberg out of London. Their stock is up by 1.85% in the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley is ending bonus caps for its bankers who live in London. It's an ongoing shift in the UK towards paychecks that look more like the bonus-heavy ones in New York. Morgan Stanley saying in a filing that it is replacing the current restriction with a, quote, appropriate internal bonus cap. The bank says it continues to pay competitively and rewards strong performance as it joins JPMorgan and Goldman Sachs to implement the new pay structures. Big tech companies are looking towards nuclear energy to power the next generation of data centers needed to support AI. Amazon is moving towards a deal with Constellation Energy, which is the U.S.'s largest owner of nuclear power plants, that according to a report from the Journal. The deal would support AWS, its signature cloud product. Amazon had also purchased a nuclear data center in Pennsylvania back in March. And the numbers keep coming in strong for Pixar's Inside Out 2. The movie's only been out for 3 weeks, but it's pulled in nearly $470 million in North America and well over $500 million internationally. That pushes its total globally past $1 billion. It's the first film of the year to reach that milestone, and doing so in just 19 days is a new record for an animated film. And that's your Bloomberg Brief, John.
Those pictures actually made Bramo smile. Danny, thanks for that. What's that about? You watched this movie?
I did, actually. Did you read there was an article about how Barbie and Inside Out 2 have two completely different messages?
Go on.
That Barbie basically is saying that it's the outside world that's creating your problems, and Inside Out's 2 saying it's basically your inside world, your own personal anxiety that's creating the problems. It was just sort of interesting. I highly recommend Inside Out 2. I thought it was
therapy for adults.
100%, actually.
Yeah, for kids too.
I mean, it's basically, post-pandemic, everyone's overly anxious, and so they made anxiety the main character.
You're in the Barbie camp or the Inside Out camp?
Do you think that I'm more in the... What do you think, John? Do you think I'm more in the anxiety camp?
Up next on the program. Best way out of that. Up next on the program. Beginning to price a Trump win.
If it is Trump, we're going to have a hawkish foreign policy, a more protectionist. All of that is interest rate upward mobility.
That conversation just around the corner. Live from New York. This is Bloomberg. Therapy in the commercial break with Bramo. Always great. Equities on the S&P positive by 0.25%. Yield on the 10-year Treasury up by just a single basis point. A little bit less now. 440 on a 10-year. Under surveillance this morning, beginning to price a Trump win.
If it is Trump, we're going to have a hawkish foreign policy, a more protectionist. If it's a Republican sweep, which it very well could be, the extension of the Trump tax cuts, all of that is interest rate upward mobility, and I think we will see some of that. On the other hand, if we get more of this economic slowdown, that, at least for a brief time, could work in the other direction.
Here's the latest. Investors bracing for the chance of a second Trump term following last week's debate. Krishna Memani of Lafayette College writing this: the bigger risk for the bond market is the policy risks of a Trump administration. Tariffs, tax cuts, immigration and deregulation. That adds a lot of volatility in that the outcomes can be inflationary in the short term and growth depressing in the long term. Krishna is with us around the table. Krishna, good morning.
Morning.
Do you really think it's now the time to start thinking about this a little bit more seriously after Thursday night?
As an investor, perhaps it's a bit early, but you can't really ignore what happened on Thursday. And therefore, since the probabilities have gone up, and I think if that wasn't the case on Friday after the PCE, rates wouldn't have been going up. So we are incrementally moving that way. Are we there fully? Not fully just yet.
Your view, inflationary in the short run, growth depressing in the long run. Just walk us through that.
Well, so I think certain policies, such as renewal of tax cuts and tariffs, kind of curtailment of immigration and deregulation, all of those things end up being somewhat inflationary. But it is also quite possible, as it happened in the last go-around, that these tariff policies, after the initial inflationary quick rise in inflation, end up being growth depressing in the long run. Because I think if those tariffs are really substantial, the impact of that, both on consumption and overall growth, is going to be meaningful.
This type of outcome, you wrote, is not something that we have faced since COVID. It may end up being a regime changer. What is the market play to that regime changer?
Well, so the market play to that regime change is it'll cause tremendous amount of volatility as people try to figure it out. And if it ends up being growth depressing, as the likelihood is not insignificant, I think overall probably the year of the bond that we have been looking for so long, which never arrived, may arrive sometime in late 25 if the outcome is what it is.
The year of the bond, meaning that you think that there will be a huge rally in long-term bonds.
Eventually, there will be a huge rally as growth, people become far more concerned about growth than they are at the moment.
We're getting quite cute here, but are we saying short-term sell-off?
Yes.
Long-term buy?
Yes.
With tons of volatility
for
in between.
bonds. It depends. It's being cute because it's very unclear as to what exact policies would be implemented. But I think simply thinking it in terms of inflationary pressures is probably not the right take. That is, it may end up being growth depressing, and that may have bigger impact on long bonds than it is having today.
A lot of people are extremely fearful of Trump Volume 1.
Mm-hmm.
And after about 5 minutes in November of 2016, they changed their mind. What's different about the backdrop now versus then?
I think that the fact that we had one administration before. At that time, there was some confusion as to how it will actually play out, and we kind of accepted that there may be really good policy outcomes. If tariffs are the front of the agenda, I think it's very difficult to see how that ends up being very growth supportive in the long run.
There is this belief underpinning a lot of the commentary we've gotten, which is essentially the ghost of the Liz Truss moment. Comes in and haunts all of these governments and says, you behave. Otherwise, the market's going to push back and it's going to say, absolutely not. And a lot of these politicians will listen to that, whether it's over in France or whether it's in the United States, if Donald Trump gets reelected with a full Republican sweep. Do you buy that line of thought?
Well, I think it's entirely possible, but I think whether that is a high likelihood outcome, I'm not so sure. Again, I'm not a political commentator, but I think for that you will need the Congress to be in a much better or at a different place than what it is right now and what it is looking like it'll be come November.
So how much do you kind of have to be a political commentator at this point? How much do you kind of have to rearrange and hedge versus different political outcomes? And how much are you actually starting to do that?
Well, so I think it is very realistic. I take a step back. If things were, or Thursday hadn't come out the way it came out, I think the outlook for the markets over the next 6 months would have been materially different, positive. In the sense that the Fed would have cut or Fed may actually cut, and that would have a very positive impact on the market and all of those things. I think the risk to that scenario and the Fed going into the background is increasing as things move this way.
You brought up the Fed. What do they do?
Well, I think as far as the Fed is concerned, we should take them at face value. I think they said they are waiting for the data and they expect supportive data, and down the road they will cut. And I think that's how it is going to play out. Talking about bringing it forward to July and all, I think that's just a bit of nonsense.
Sure, but given everything you've just told us as an investor from your perspective, does that not apply to Chairman Powell when he sets monetary policy, the FOMC?
Again, he has told us he's not in the political arena repeatedly. So I think the driver for them has to be really real-time data, and they have told us that, and I think we have to take them at face value.
There's also a sense that once they start, they don't want to go the other way a few months later.
Well, 100%, and that is why they will wait. That is the primary reason why they unless the data is...
You say wait, can I just jump in?
Yes.
Wait until after November?
Perhaps. Again, if the data for the core PCE doesn't end up being as soft as it was in May over the next few months, they have all the reasons for them to wait. And the likelihood of not doing anything in 2024 is significantly higher than zero.
So where do you stand now? T-bill and chill, and maybe a little NVIDIA?
Yeah, I don't think that thesis has really changed that much.
Okay, but what are you doing on the margins?
The equity markets have done much better, and so it hasn't worked out that well. But from a kind of a risk management perspective, that's not a bad strategy still.
Okay, so what would you have to see to shift that, maybe?
I think if the Thursday hadn't happened, I think the driver would have been fed to kind of get a lot more comfortable with valuations and growth, but it's a reality.
Okay, but are you basically saying that because of President Biden's performance, the Fed is going to be less likely to cut rates before November?
No, that's not what I'm saying. What I'm saying is the Fed will do what it will do. The impact of what the Fed does on the market would be significantly less because of what happened on Thursday.
Just to be clear, though, you think that Treasury move was off the back of Thursday night?
Yes, absolutely. Otherwise, with the PCE data that we got, the likelihood that you have a bond sell-off, I think that would have been very, very unlikely.
So the short-term risk of this bond market sell-off?
I think as policy uncertainty increases, I think the curve steepens rather than flattens.
Absolutely fascinating. This is what we heard, by the way, from Morgan Stanley as well, looking for that steepener in a yield curve.
Yeah, that was what Matt Hornbach was saying, and that's what we're hearing from JPMorgan's David Kelly as well, that it was a game changer, that we saw a real shift in terms of both market expectations and political expectations. Thursday night was a game changer.
Krishna, does it ever happen this early in election cycles to really be doing this in the end of June, start July?
Well, but I think this was extraordinary. I don't think something like this has ever happened before, where you had some level of political, if not certainty, likelihood, and that getting demolished in one day. I think that's very unique in U.S. elections.
Is there more to this trade? If we saw Friday at the beginning of it, even before the election, is there more for the sell-off, just in anticipation of what could happen?
I think, again, if the Fed acts the way that market expects it to, the likelihood of that being supporting for bonds in the short run, I think, is significantly less now than it was before.
Amazing. Krishna, it's good to see you.
Good
so much to
well.
think about. Krishna Memani there of Lafayette College, thinking about trades for the election on the 1st of July.
Well, I mean, this just sort of raises this question of game theory. At a certain point, we start talking about whether Joe Biden's going to step down. What if the market provides a check on him? I'm serious. I know it sounds really far-fetched, but we're at a point where, I don't know, anything's possible.
My head's spinning already.
Yeah, mine is too.
It's going to keep spinning. Coming up in the next hour, Cameron Dawson of NewEdge Wealth will be joining us. We'll catch up with George Ferguson of Bloomberg Intelligence. Lots to talk about on the Boeing front. Then we'll speak to Yelena Shulyatyeva of BNP and Steve Ricchiuto of Mizuho, looking ahead to a week full of economic data and a conversation with Chairman Powell tomorrow. Equity futures positive by 0.25% from New York. This is Bloomberg.
Incoming data, in particular the more important data, it still shows the economy doing well.
Even with further progress, while welcome, it's still not enough to justify a top-line move in terms of monetary policy.
Interest rates have done their job. They've brought demand and output down from the peaks we saw.
I always say to people who want the Fed to start ASAP and move quickly, be careful what you wish for.
The more likely error right now is that the Fed will not start cutting early enough and then will overshoot on the way down yet again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I've got to say, it's already been quite an interesting start to Q3. Already this morning, a few hours into the programme, guest after guest talking about the prospect of a Trump presidency. After Thursday night of what it means for financial markets, we heard it from David Kelly of JPMorgan, heard it just moments ago from Krishna Memani.
I'm so glad that's where you started. To me, that's my big takeaway, this idea that Thursday night was a game changer, not just for the political sphere, but also for markets, as people game out the implications of not only a Trump presidency again, but also what a Republican sweep would do for both the deficit as well as immigration policy.
Consensus forms slowly. What I've been surprised about so far this morning is just hearing a series of guests talking about how depressing it would be for growth. And surprised by that. And you saw that from Morgan Stanley's Mike Wilson too, that risks are skewed to the downside for growth under Republican win scenarios. Make sense of that.
Well, it kind of flies the face of a bond market tantrum, because if you think of suppressed growth, that typically would indicate some sort of flight into Treasury. So this raises the question that Krishna Memani was saying, and you could say it's too cute, but initially the knee-jerk reaction would be to the tariffs and to the potential inflationary pressure. Longer term, growth would come into question. A lot of hypotheticals. To me, the larger issue is, at what point does the market act as a check on what some of these policies could do? We've heard that both in France. Now my question is, in the United States, is the ghost, and I keep saying this, but it just is an interesting idea, is the ghost of a Liz Truss moment really hanging over some of the political shifts that we're seeing both in the US and in Europe?
Got this vision of Liz Truss sort of hovering over bond markets.
Oh, me too.
Now. It's a vision I want to get rid of.
It's actually a big head of lettuce, just hovering.
These are the hypotheticals, or baguettes, based on what's happening in France. It's not my joke, that's someone else's. We can confront the economic data. This week ahead's fascinating. The ISM a little bit later today. Jolts. We'll get the ADP, we'll get jobless claims, we'll get payrolls on Friday, we'll get some Chairman Powell commentary as well. There is a much, much bigger focus again, a renewed focus on the labour market.
At a time when the Fed seems to be increasingly focused on potential weakness in the job sphere rather than any kind of ongoing stickiness in inflation. Issue to me is there's been a lot of confusion. Even Jay Powell himself saying he doesn't really understand the divergence between the household survey and the others, and basically saying it does seem like maybe, what was his word?
Overstating.
Maybe it's overstating the actual data, which is the reason why the jolts will be interesting. Do we see an increase in some of the skepticism result in a decrease in potential available job openings?
Going into all of that, the price action looks like this. Here are your scores on the S&P 500. Equity futures positive by 0.25%. In the bond market, yields a little bit higher, up by double digits on Friday. Up by more than 10 basis points on a 10-year, up another single basis point this morning, 440.99. In foreign exchange, we talked lots already about round one of voting over in France, the euro. At least we're a little bit stronger here by a third of 1%, 107.47.
It wasn't as big of a win as it could have been. So I guess buy euro. I just wonder how much this is people kind of shrugging off how much of a political shift this could actually be. We heard from so many people looking for opportunities to buy into the weakness that we saw in the French bond market. Whether it sticks and how far it will go will be a key question as we head into round two.
We've done this once already this morning. Let's do it twice. I want to pick up on the question you asked. It's the right one. Whatever happens over the next week, do spreads, the difference between the French 10-year and the German 10-year, go back to where they were, around 40? Or do they stay at these levels or maybe even carry on grinding wider? And what we heard from TD is we're not going back to the 40s anytime soon.
Because ultimately you still have this shift, this swing in some of the political sphere. In France, I just wonder the other side of this trade. Germany isn't exactly some bastion of stability in terms of its political sphere. So at what point does that become part of the equation too? And you just see an increase in yields in both sectors.
Cleanest shirt. Something like that.
I love that discussion.
Yeah.
It's
Okay.
really good.
That's where we're at. Coming up this hour, this is your lineup for you. Cameron Dawson of NewEdge Wealth as the third quarter kicks off. George Ferguson of Bloomberg Intelligence on why the DOJ is set to charge Boeing. And Mizuho's Steve Ricchiuto on why he's sticking with his call for no rate cuts in 2024. We begin with the big issue, positioning for the second half. Cameron Dawson of NewEdge Wealth saying this: the trend is still your friend, powerfully up. Don't fight the trend of positive equities, but be aware that the market could shift quickly if growth forecasts for EPS or GDP begin to get trimmed Cameron joins us now for more. Cameron, good morning to you.
Good morning.
Are we starting to see that already? Are those growth estimates starting to be trimmed?
It happened Friday. For the first time in 12 months, we saw 2024 GDP estimates get revised lower. It's just slightly, and it's just one data point, so it's not quite a trend yet. But that is a big shift from the last 18 months, where we've had rising GDP forecasts pretty much every single month, which has provided a boost to equities, provided a boost to credit markets. That's why you can trade at such high valuations, such tight spreads, because you're raising forecasts. If that starts to change in a more meaningful way, that's when you could have a more risk-off move.
Growth has started to disappoint relative to expectations as well. That's been a theme with the incoming economic data. Can you walk us through what you're looking for in the data this week? Are you in the camp of Mike Darda, where you think that we're weak here and the Fed's got to respond, or David Kelly, where things are slowing but they're not slow and this is just normalization?
I think it is more of the normalization. We're not at the point yet where things are falling off a cliff that you say we're headed deep into a recession, but we're definitely coming off the boil. And if we think about the labor market, to your point earlier, you have two very different stories about the labor market. We think it's much more likely that it's somewhere in between, where the real jobs number is somewhere around 100,000. What that means, though, is more important for the unemployment rate, because we're already at the Fed's target for this year at 4.0%. If that continues to creep higher, and if you continue to see this moderation in the PCE, it does give the Fed the degrees of freedom to at least do one rate cut, maybe two rate cuts this year. But then the question is, what happens in 2025 if they start to ease policy, fiscal remains stimulative, and then we start thinking about that Republican sweep?
You say that it's important to just keep going with this momentum trade just simply because it is so powerful. And yet something that Torsten Slok put out there was the top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of earnings. We are basically pricing in a much more significant boost to earnings in some of the names that have been delivering, let's be honest. Does that concern you at all, that if we do get a reality check, it will be a painful one?
We are slowly shifting from a world where the stocks were going up because earnings estimates were getting revised so much higher for these big mega cap names. The market was just chasing the earnings estimates higher. Now we're at a point where it's really multiple expansion that's boosting names like Nvidia, like Amazon. And so the question is, how much can that sustain, mostly as the earnings growth rate for the Magnificent Seven decelerates significantly into 25. And even into the back half of this year, you're going from a peak of over 60% growth for Mag 7 names to about 15% by the time we get to the fourth quarter. And interestingly, the market has priced in that the rest of the 493 will have about the same amount of growth. The challenge with that, though, that's a really high bar for those 493 names to see mid-single digits or mid-teens kind of growth, which just means there's room for downside surprise in earnings.
Well, this is something that David Kostin of Goldman Sachs really picked up on, that basically that earnings bar is the highest going back to 2021. This all paints sort of a bearish picture, and yet you're still bullish. So how much do you sort of shift your position based on something that you see in the data or based on an earnings report versus just go with momentum because that's what's working?
Yeah, the trend, the momentum, and the liquidity has been so supportive. We think it really becomes more of a challenge into 25, where we do think 25 estimates are too high. If you unpack them, you have GDP or revenue starting to accelerate and 100 basis points of margin expansion. That's in a world where nominal GDP is going to decelerate. You typically don't get revenue accelerations and big margin expansion in a moderating nominal GDP kind of economy. So we think the $278 a share for 2025 is firmly too high, but it may not be yet that we're starting that revision down cycle.
There's a phrase you used, you said, and then it was followed by Republican wave.
Yeah.
Is it too early to start considering that right now?
Based on the polls, no. And I think the interesting thing is comparing the starting point of a potential Trump presidency today versus 2016. In 2016, the unemployment rate was 4.7%. Wage growth was growing in the mid-twos. That's different than today. Wage growth is growing at 4%. So if you do something that constricts labor supply, what is the risk that you see a more pernicious kind of wage inflation cycle if you lose that bottom tier of workers that are coming in that have helped keep wages in check? I think you can do a similar thing on tariffs, where you had deep deflation of durable goods at the start of his presidency. Durable goods inflation went from negative 2.5% to about flat. So how much could you see tariffs and immigration contribute to this inflation outlook?
So am I selling bonds?
I think that the risk is that yields do move higher, because the other thing we heard from the debate is that neither party is considering austerity whatsoever. So get used to higher Treasury issuance in order to fund the deficits.
So you basically agree with what Krishna Memani was saying, that Thursday night on some levels was a game changer in terms of your market views and the increasing certainty around a potential outcome in November?
I think that the best output for this economy would be gridlock, meaning that they can't do too much. Don't change it. If it's not broke, don't fix it. The challenge is based on Thursday night, does that raise the odds of a Republican sweep where you could see more sweeping policies? You could see the full extent of the effort of policies actually be enacted. And I think that would be the risk for the market, is that you do get this inflation, you do get higher deficit spending. And to point out, the tax cuts that you would potentially get going into a second round of a Trump presidency are not nearly as big as what we got in 2017, meaning we had those tax cuts to offset these other things. You're talking about 1% to 2% lower in the corporate tax rate. So you don't get nearly as much sugar as you get with the spinach of things like tariffs and immigration.
We're hearing this repeatedly throughout this morning. Cameron Dawson there of NewEdge Wealth, another guest, Bramo, building on the work of Friday off the back of Thursday evening.
Yeah, I like spinach, by the way. I'm just saying, people say sugar versus spinach. Spinach isn't terrible.
But your vegetables, whatever.
Okay, but I agree with you. I think that this, to me, is probably the biggest takeaway of this morning so far, is that essentially people are saying that Thursday night was a game changer for markets, not just for politics. And it comes to a point where you start to have to really contemplate some of these policies getting into effect without any barriers whatsoever.
Yields creeping hard this morning by 2 basis points on a 10-year, just a little north of 4.41. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Hurricane Beryl is set to cause massive damage across the Caribbean's Windward Islands throughout this morning. Right now, the storm is moving west as a Category 3 hurricane towards Barbados, St. Vincent, and the Grenadines. The National Hurricane Center says fluctuations are expected within the next day or so, and the storm's gusts are still life-threatening. It will potentially threaten Haiti, Jamaica, and the Cayman Islands throughout the week before possibly making landfall in Mexico on Friday. BlackRock is nearing a $2.5 billion deal for private capital data provider Preqin. That, according to people with knowledge of the matter. The deal may be announced as soon as today. It would also make Preqin's founder richer than his new boss, Larry Fink. Mark O'Hare owns nearly 80% of the firm, so after taxes, he will net roughly $2 billion. Fink's net worth is $1.7 billion. Preqin competes with Bloomberg LP, the parent of Bloomberg Television. And more on the crazy weekend for sports. In Austria, George Russell clinched Mercedes' first win of the Formula One season, but not without some drama. A late in the race crash between frontrunners Lando Norris from McLaren and Red Bull's Max Verstappen cleared the way for Mercedes. Norris was trying to take the lead from Verstappen. Instead, the crash forced him to retire from the race, and Verstappen suffered a puncture and a 10-second time penalty for the crash, ultimately finishing in fifth. And that's your brief, John.
Danny, thank you. Haven't seen an end to a race like that in a long, long time. Toto Wolff of Mercedes was so surprised by what was happening, he pressed the button and got in the ear of George Russell and started almost celebrating that he could win. And George Russell said he almost crashed because of that.
Just out of the surprise.
The end of that race was just ridiculous, and you could see it coming. Norris and Max are actually friends off the track, and I wonder if they're actually going to kiss and make up after what happened Sunday.
It just shows that that's the only way for Max Verstappen not to win, is essentially a massive crash.
Something like that. Caused by him, I have to say. Caused by him. Up next on the programme, the morning calls. George Ferguson of Bloomberg Intelligence joins us too, on why the DOJ is prepping criminal charges for Boeing. The latest reporting from the team here at Bloomberg just around the corner. From New York as we kick off Q3. Can't believe it's July. Ridiculous. Equity futures positive by 0.25% from a beautiful New York City. This is Bloomberg. A little more than an hour away from the opening bell, with equity futures positive by about 0.25% on the S&P. Yields drifting a little bit more higher by 2 basis points. 441.58, and the euro stronger by, let's call it 0.25%, at 107.43 on euro dollar. The time now for some morning calls. First up, Wells Fargo adding Kroger to its third quarter tactical ideas list. The firm seeing strong potential for an earnings beat against a wall of worry for grocery chains. The stock is up by a couple of tenths of 1%. Your second call from Morgan Stanley, raising its price target on Nvidia to 144. There's another one. There's always one. The analyst raising 2025 estimates, but also noting frothiness is lower than it once was. Believe it or not, Lisa, kicking off Q3, we're down about 0.75% on that stock.
Wow. The fact that it's down must mean that it's time to buy. It's a dip. Honestly, at this point, if they can increase their earnings expectations, well, I get it.
Absolutely ripping again for 2024. And your third and final call, Canaccord raising its price target on Rivian to $30. The analyst highlighting the EV maker's, quote, monumental partnership with Volkswagen, calling it a game changer of a transaction. We're down on that stock by about 0.5%. Let's stick with transportation. Boeing is still in the spotlight. Bloomberg reporting that the DOJ plans to slap criminal charges on the plane maker related to 2 fatal 737 MAX crashes. This is Boeing is set to buy back Spirit Aerosystems in a $4.7 billion all-stock deal. George Ferguson of Bloomberg Intelligence joins us now for more. Now, George, 2 stories here. As you know, the reports of the DOJ criminal fines and the story that ultimately they're going to get back together with Spirit Aerosystems. Can you walk us through the second story, how beneficial this will be to both companies?
So I think the second story, Spirit Aerosystems, is extremely important to Boeing, because this is just going to give them an opportunity to streamline the manufacture of the Boeing 737. That's the big money maker for the company. It generates a lot of the cash flow, a lot of the profits. And so, really the path for the recovery for Boeing flows through getting MAX 737 production and deliveries higher, up into the 40s and 50s at least, with a view towards even better numbers than that. And so I think given this streamlining, I think it's going to give Boeing the opportunity to really get things done down in Spirit that they need to stabilize the manufacturing process. I think very interesting as well this morning, Airbus announced it wasn't a purchase. They're taking away of the Airbus portion of Spirit Aerosystems work, and they got paid $559 million to take that business back, which is sort of another confirmation to us that Spirit had given Airbus a pretty nice deal on 350 and A320 manufacturing. I think that's going to help a lot as well, because you take that pain out of Spirit Aerosystems that they would have had if they hadn't got reabsorbed by Boeing.
George, as you alluded to, the underlying hope of many investors is that production starts to ramp higher again. This sort of folds into the story that we've been writing here at Bloomberg on the DOJ, set to charge Boeing. And some of the options here, ultimately the DOJ is telling Boeing to pay a fine and hire a corporate monitor. I just wonder how constrained they'll be by the regulator going forward from here, even with this combination.
Yeah, so, I mean, from what I'm reading and from, if the information is coming out from over the weekend, to me, it doesn't sound terribly constraining. Now, I don't totally understand how much influence that monitor will have. Obviously, it should have a lot on Boeing production. But I think, really quality had slipped so hard here at Boeing for so long, and there were so many problems that I feel like they almost ought to just welcome that and bring that in-house, because I think fighting over, monitoring right now at Boeing it looks bad, right? And the fine itself doesn't look that material to me as a financial analyst, $200 million. And it feels to me like they don't want a fraud conviction against the company. I'll point out the caveat, I'm not an attorney, but it seems to me that with a fraud conviction, they could have other problems with government contracts. So it seems very doable for them to sort of, put that away, put that aside at this point, and admit.
Is there a sense that Dave Calhoun can still right the ship at a time where his leadership is set to end, unclear who's going to take his place, and the real questions about his credibility, given that they have yet to really solidify what exactly went wrong?
Yeah, I mean, I guess I don't know that I see Dave Calhoun as the ship righter, if you will. I guess I see, unfortunately, there's no delaying, I think, this DOJ issues and the Spirit Aerosystems issue, and the CEO search is super important. So I think you can't really accelerate it. You can't, shortcut that whole thing. So I kind of feel like Dave Calhoun's more of a caretaker here, and it would have been nice to have these situations fall to the next CEO, but you can't wait around. So I think in some ways, Calhoun's going to help maybe clean up some of the mess here as he goes out the door. A mess that's not all his, but clean up some of the mess. But this is the beginning of a longer process of righting the ship. And, it goes through the manufacturing plants. It goes through stabilizing quality, improving builds. And so it's the beginning, but I don't think he's righting the ship.
There's a larger question, and forgive me, I'm thinking aloud here, George, but it feels like at a time where the United States and other countries are trying to emphasize industrial prowess and industrial production, Boeing acts as a sort of cautionary tale, not just for sort of central planning, but also for this industrial ability at a time where a lot of industrial centers were hollowed out during the pandemic and where it hasn't been a skill set that has been prioritized in a lot of communities. How much is the ambition of becoming an industrial behemoth challenged by some of these shifts that we've seen in the labor market as well as the post-pandemic realities?
Yeah, I think there is a bit of that that's sort of gone on in America over the last couple of decades. And I think there's been a heavy focus on financials. And in that focus for financials, you push things out to lower cost locales, and you let other people do the engineering and the manufacturing. And I do think it's been going on for, I think, decades for Boeing, and we're seeing it now. It's sort of manifesting itself all at one time. I think because of the stress of the pandemic, because of the stress of the MAX crashes were the indicator prior. But I do think it's a little bit of a cautionary tale for manufacturing. And I think you've got to be prepared to control the important portions of your manufacturing process, especially the engineering. There was a time where they were talking about pushing some of the design, and they tried in the 787 out to suppliers. I think if you're going to be a great manufacturer, I think you want to keep those skill sets, at least the important parts of it, in-house and not be so financially focused. And I guess we'll see, but I think it is a cautionary tale.
Hey, George, good to hear from you. George Ferguson there of Bloomberg Intelligence. George giving a nod to the potential fine. Let's go through the numbers. This from the team here at Bloomberg. The department will inform Boeing it will have to pay an additional criminal fine of $243.6 million on top of the $243.6 million already paid back in 2021, that deferred prosecution agreement, bringing the total amount of fine close to $500 million. So, Lisa, I won't offer my opinion on that. Maybe the stock can. Boeing's down by just 0.4% at the pre-market.
Yeah, well, I'm just thinking about how much the cost is for an average plane, and you think about how many planes that really accounts to, and ostensibly, especially if they're able to ramp up production, that probably won't be that significant. The question is whether they can ramp up production, and the perception-wise, what this does to not only the competitive edge, but their ability to attract the talent that they'll need to really come out of this period a stronger company.
It's a slow burn. That stock is down by 0.4% in the pre-market. Up next on this programme, just around the corner, we'll catch up with BNP Paribas' Yelena Shulyatyeva alongside Mizuho's Steve Ricchiuto. We'll talk about the economic data still to come this week, Chairman Powell tomorrow in Sintra, Portugal at the ECB's big annual get-together. This comes from Andrew Honhorst of Citi just moments ago. His estimate for Friday, Lisa, they're looking for 155,000 new jobs and a 4% unemployment rate.
Yeah, they've been looking for just a general weakening. Just to sort of catch up, I was looking at this. A new 747 plane, not to go backwards, but
we can go
costs
backwards.
$250 million. So that's one plane that would be the fine. This is sort of what I wanted to get at. To the point of the data, I do think that Andrew Hollenhorst's point is an interesting one, that we're going to see a steady weakening, and whether the labor market data for this week will really kind of be maybe the cap on a lot of the data that we've been seeing.
I think most of us at the beach sort of with the Bloomberg Anywhere on, looking for payrolls to drop. Is that what we're doing on Friday?
The truth is, we're both off. And yes, we'll both be checking, I'm sure.
Obviously. Yes, Bloomberg Anywhere. $60 minutes away from the opening bell in New York City, with equity futures positive here by 0.25% on the S&P 500, on the Nasdaq positive, also by 0.25% on the Russell. The small caps up by 0.4%. Can the rest of this market, Lisa, actually do something after tech leads some big gains for the Nasdaq?
Some people say that's really the ultimate test at a time where the question is whether some of the underperformance of the rest of the 493 stocks is a warning sign for what's to come, a sense of the weakening that a lot of people are expected to see in the data.
Turn the page, switch up the board and get to the Treasury market. We're down here. Yield to higher across the curve. Up 2 basis points on a 2-year to 4.77. On a 10-year, up 4 basis points, Lisa, to 4.44. Guest after guest so far this morning talking about a bear steepener of this yield curve on the prospects of a Trump win in November.
Guest after guest saying Thursday night was a game changer, not just for politics, but also for markets, where suddenly the chance of a Republican sweep becomes much more in focus. And the chances that, at least in the near term, that's going to be inflationary and potentially send longer term yields significantly higher.
What does this mean for the FX market? Let's turn the page and get to foreign exchange. The dollar's had 4 consecutive weeks of gains. For the euro dollar looks like this. That exchange rate at about 107.41. We're positive by about 0.25% on the euro this morning off the back of the French election over the weekend. So let's get to that. Under surveillance this morning. A top story, an inflection point for French President Emmanuel Macron as centrist alliance and left-wing rivals now weighing whether to pull candidates from the second round of the election in just under a week. The discussion coming after Marine Le Pen's national rally dominated the first round of voting. We're seeing spreads a little bit tighter. Germany versus France, the euro a bit stronger, French equities recovering, but still huge question mark over the future of this government.
And given the fact that Marine Le Pen didn't get as much support as some people expected, doesn't take away the fact that she dominated and that her party came in first. Key question that sort of underpins a lot of what people are saying is there a shifting tone in what the far right looks like? We talk about what we saw over in Italy, whether this is the exact same kind of threat that some people thought that it posed as it was in the past. And that's key to understanding whether the left and the center could kind of make some sort of coalition to counter that potential threat.
I think what we've seen on the right, and we have a case study for it in Meloni, is that they're trying to prove that they can govern and that they can govern without crisis. And that's ultimately going to be the path to long-term success. And you can hear that from Marine Le Pen, the way they start to talk about their policies. It's a recognition that they can't go as far as maybe they would have liked to.
The ghost of the Liz Truss moment.
I mean, possibly,
hanging over the markets in France, hanging over the markets in the United States. I mean, is that really ultimately what we're talking about?
You don't want to be the crisis candidate. You want to be the populist game changer. I get all of that. But ultimately, it's a tightrope you've got to walk. You've got to be one and the other at the same time. You do not want to be the crisis candidate.
You do not want to be Liz Truss, which is the reason why her ghost is hanging there. Ultimately, how much does this act as a check on what some of the most extreme policies could be?
Yeah, and that's going to be the story maybe for us later this year in this country. Will this Treasury market act as a regulator for some of the ambitions of whoever gets in power later this year? Elsewhere, trouble continuing for Boeing. We talked about it briefly earlier. If you missed it, here's a summary. Bloomberg reporting the DOJ plans to slap the plane maker with criminal fraud charges related to 2 previous fatal crashes. This as Boeing agrees to buy back Spirit Aerosystems. The deal expected to improve manufacturing, but will saddle Boeing with more debt. That stock is down, Lisa, by just 0.75%.
You know, you just wonder when this story is going to end up ending. In terms of the fine, we did point out that $240 million fine is equal to about 1 plane sale. So it's not exactly going to cripple said company. Yet there is this feeling, when is this going to end and when are they going to actually develop the prowess to really make planes at the pace that a lot of the airline companies would like?
Longer than they would like, that's for sure, based on recent events. The week ahead's packed. We've talked about it a few times already, I know. Looking ahead to the week ahead, Fed Chair Jay Powell speaking tomorrow at Sintra ahead of New York Fed President John Williams on Wednesday. We'll get a rush of jobs data, including JOLTS, jobless claims, and the June payrolls report on Friday. Mike McKee's with us around a table. Mike, your week is a busy one.
It is a busy one, and politics, as you say, kind of overhanging all of it this week. I get to break the ISM manufacturing numbers at 10 o'clock this morning. And, of course, at 10 o'clock this morning, the Supreme Court rules on Donald Trump's immunity. So you got to have a very wide brain to take this all in. But ISM would be interesting because basically the narrative is the economy is slowing, and the manufacturing ISM has been below 50 for quite some time now. Does it go over that and disturb that narrative? As you mentioned, Powell and the French president of the ECB are in Sintra together on a panel. So you can bet what some of the questions are going to be tomorrow. Then, as you mentioned, a lot of job stuff on Wednesday because we get jobless claims and ADP, ISM services, everything packed into that day. Because, of course, on Thursday, you're all going to be at the beach. Friday, June jobs, and that's going to be
You'll be here, I hope.
Yeah, I will be here.
Good.
I'm hearing not everybody around this table is going to be.
I'm a loyal viewer, listener of Bloomberg Product, and I'll be listening and watching to Mike McKee break down the numbers.
That's so emotional. I'm sure he's very appreciative of that.
Of course he is.
I'm sure he much
debating whether to wear a tie or not for you.
I think you should wear a tie on Friday. I will ask you this about Friday. How are you going to navigate these numbers when Chairman Powell comes out and suggests that maybe they're overstating the true strength of this economy?
Will he? I mean, that's going to be an interesting question to Powell. We did ask in the news conference about the difference between the household and the establishment surveys. And nobody can really explain the household surveys, so they're kind of looking through it. We'll see what we get here. Again, we're looking at 188,000 as the consensus forecast, and everybody says, well, that's way down from last month. But last month was way up from what was expected. So we're still running fairly strong. But the kind of amazing thing this month is we get so much Powell. We get Powell tomorrow. We get Powell the following week with his Humphrey Hawkins testimony on Tuesday and Wednesday. The week after that, he's at the Economic Club of Washington. And then the final week, he gives his news conference. More Powell, I think, in a month than perhaps we've ever seen. So it isn't going to be hard to know where the Fed is.
July, going full Powell. So here's the issue. Which data is actually going to move the needle the most? People were talking about the unemployment rate as being maybe one of the key aspects. JOLTS also tomorrow, front and focus. What are you looking at most importantly?
Well, we'll look at unemployment because the Fed is looking at unemployment as an indicator that the economy is slowing down. And it's maybe a little bit of a radar gun. For speed, how fast the economy is dropping. If we got a big rise in the unemployment rate, that would change the narrative. And then beyond that, we'll be looking at CPI the following week on the 11th as everybody keeps track of what's going on with inflation.
Just a week away. Mike McKee working so we don't have to. Mike McKee, thank you for that and for everything you do. Joining us now is BNP's Yelena Shulyatyeva alongside Mizuho's Steve Ricchiuto. Great to have the both with us. Yelena, I want to come to you first. This is something you said, and I repeated a little bit earlier this morning. Should have attributed it to you. When I said someone says this, I mean Yelena says this. You're looking at the jobless rate on Friday more than you are the actual headline payrolls number. Just walk us through that.
Sure. So I think the range of payrolls will be pretty wide. That could satisfy the definition of gradual normalization rather than deterioration in the labor market. So we can see payrolls, as low as 150 probably, or as high as 250, and that's going to be just fine. What is really important in this upcoming report is the unemployment rate, because it increased in the last two reports. And if it increases again, that could potentially trigger the SAM rule. And if it goes, say, to 4.2%, that could trigger the SAM rule. Whether it's a recession or not, that's a big question, but that could spook the markets for sure. We are looking for an unchanged reading on the unemployment rate, just simply because the previous number was driven higher by young adults looking for a summer job. So I don't think that is sustainable. That's one off factor. But it's possible that the unemployment rate could be quite interesting on Friday.
Steve, let's bring you into the conversation. Would you agree with that?
Well, I mean, look, the unemployment rate is clearly a highly political indicator. It gets a lot of press. People tend to understand what it means. So therefore, it does have importance in terms of the overall dynamics in here. We also have to understand that, 4% is still a very, very low unemployment rate. It may be up off the bottom of 3.7, but it's still a very, very low unemployment rate. And it's still well below the natural rate of unemployment. So therefore, I think, saying, 4.1, 4.2, this is going to signal a recession or things of that matter. When you've got industrial production that's been good, you've got initial unemployment claims that are low, you've got payroll employment that's going to be a very, very healthy number. All kind of argues to me that we're making, mountains out of molehills in here.
Steve,
this economy's doing well.
And you've been one who's been talking about how maybe the Fed actually has to worry more about a resurgence in inflation than anything else, and that you still sort of think maybe these concerns about growth are a little overdone. What are you pointing to? What do you think is going to sort of give that sense in the data this week, or that's under the hood that maybe people aren't recognizing?
Well, the jobs numbers themselves are critical to what's happening in terms of the underlying pace of economic activity. Jobs create income. Income and hourly earnings create wage compensation, and wage compensation is what drives consumer spending. You've had a little bit of an inflection in consumer spending in the second quarter relative to the first quarter of the year. But again, we've been anticipating an inflection point in the economy because we're shifting down from a 3.3%, which is well above trend, to a 2.3%, which is still above trend growth environment. So you're going to see some flexibility in the data, and I think that flexibility is coming through, and people are overreading it because they want to believe. The Fed tells you they want to cut rates, so therefore you read every number as, oh, this is the one that's going to get the Fed to move because they're telling me they want to move. They're itching to move, so therefore they're going to move. Yet the Fed has repeatedly pushed out the timing of rate cuts, and as a result, they have a winning hand. They're getting a macroeconomic environment that fits their scenario. They're getting an interest rate environment that fits their scenario without doing anything because the market keeps on saying, this is the number that's going to make them cut rates, and therefore nobody could short this market.
Yelena.
Yes, I agree with Steve about the pace of consumer spending and consumer income. Actually, last Friday, we got some numbers that are pointing to a very strong growth in consumer income. So, yes, we did see some moderation in consumer spending, particularly on discretionary services categories. But I think we're fine in terms of we're not deteriorating, we're growing slower. And that's the key point here. I think the numbers that I will be watching this week also include JOLTS. JOLTS data is very important. Are we going to see a slowdown in the decline in openings? That's a key point for me because we're at the point on the beverage curve when further declines in vacancies could lead to high unemployment rate. And again, that goes back to that point I made about the unemployment rate. That is becoming much more important over this period. So if we see a significant decline in vacancies, that's going to be a warning sign. I don't think that's going to happen.
As Steve Ricchiuto said, 4 is still very, very low. But you also mentioned the SARM rule. When you start to creep towards 4.2%, how rare is it to start to inch higher and then just stabilize at these levels?
It's very rare. But I think everything in this business cycle is very rare, right? We haven't seen much of what's going on back in the history. So I think the speed of increases in the unemployment rate really matters. So if we see, a rapid increase to 4.2% or 4.5% going forward, that's going to be very warning, like a warning signal. If we gradually rise to that level, say 4.2% by the year end, that's going to be just fine because it's the SAM rule will not be triggered.
Steve, this has come up repeatedly on this program. How much daylight is there between deterioration and just normalization?
Well, there isn't that much in terms of people's expectations because the market has been told the Fed wants to cut rates. So the market has this skew. But the reality is there's a lot of gray area in the data, and there's a lot of gray area in the terms of the interpretation. And this is one of the risks that the Federal Reserve, takes in here if they were to cut interest rates without having the data on their side. You could wind up with an overreaction in the market. And Jerome Powell indicated this in his last press conference, that they were worried about an overreaction if they were to move policy. And that overreaction then could lead to a reacceleration in growth and put them in a real political bind with their own analysis. So I think the Federal Reserve has to move very, very cautiously in here. And I think they need to see clear evidence before they move monetary policy. And I don't think they're going to get it in any of the data that's coming out here or in the next few months.
The discussion that we're having right now is one that we could have had last week at a time where it was pre-debate, I guess PPD, pre-presidential debate in the United States. We've talked to a number of different people here on the show this morning talking about how it was really a game changer, how we really saw a shift where suddenly the likelihood of a Republican sweep became greater and the implications of that. Yelena, does it change things for you in your economic forecasts when you take a look at all of these sort of competing factors within the labor market and the overall economy, and then you factor in what would higher tariffs do? What would lower immigration do?
Absolutely. That makes 2025 picture more inflationary, right? So the probability of higher inflation next year has risen after the events. I think it's really important to look at tariffs policies, tax policy, and all of the immigration, of course, and all of it. Our team put it in a model, and that spits out a very inflationary outcome for 2025. It doesn't affect growth that much in the initial run of the model, but if you factor in the Fed policy and how the Fed will have to react to inflationary environment, that could really push growth down, and that's going to be a bad outcome, of course.
Steve, do you agree with that? And is it sort of a game changer in your view, what we saw Thursday night?
Not really. I mean, I think either one of them were going to lead to an inflationary tendency in the economy. They're both going to spend money. We're just going to spend them in a different way. And we're both going to have inflationary implications from policies. We just choose to pick on some versus other. The reality is we've got a $2 trillion structural deficit, and we're heading to either a $2.5 or a $3 trillion deficit as we go forward in here. That's additional fiscal stimulus at a time when the reality is monetary policy is not as restrictive as the Federal Reserve thinks, which is one of the reasons why we've been saying they shouldn't be cutting interest rates in here or even considering it, because monetary policy is not that tight, because we think the neutral level of the Fed funds rate is closer to 4%. And with the forward structure of interest rates anticipating, 3 to 3.25 by the end of 2026, forward rates aren't particularly regressive in here. So I think the reality is we're going to have a stronger economy from government spending in 2025, 2026, no matter who's in the White House.
Steve, still looking for no cuts in 24. Steve Ricchiuto of Mizuho. Steve, thank you, sir. BNP's Yelena Shulyatyeva as well. That final question there, Bramo, it's an important one. And we heard what we heard from Krishna Memani. We heard it again, which ultimately is in the near term tailwind for inflation, in the long term headwind for growth.
Which is really the key question here. How much do people have to start factoring that in at a time where it's looking more likely, at least based on the polls, which you can reject if you want, or you could say that maybe these policies are going to shift, or there's going to be the ghost of someone hanging over the idea here that maybe there's going to be pushback against some of these proposals. Nonetheless, person after person today has said this was a game changer and it would be more inflationary and potentially slow growth longer term.
When are we going to get past this Liz Truss nonsense? How long is that going to take?
If it's up to me, we're not getting past it for a long time.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get out to Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu is vowing once again to continue fighting Hamas until the militant group is eliminated. Netanyahu spoke after an Axios report that claimed the Biden administration sent around amended language for its ceasefire proposal between Israel and Hamas. The report goes on to say that the U.S. is working with Qatari and Egyptian mediators to change what's in the first stage of a three-part deal. Big tech companies are looking to nuclear energy to power the next generation of data centers needed to support AI. Amazon, for its part, is moving towards a deal with Constellation Energy. That's the U.S.'s largest owner of nuclear power plants. That all according to a report from the Journal. The deal would support AWS, its signature cloud product. Amazon had also purchased a nuclear data center in Pennsylvania back in March. And shares of Chewy this morning up 11.33%. The stock gaining a boost after Keith Gill, a.k.a. Roaring Kitty, disclosed a 6.6% passive stake in the online pet retailer. The stake is about $245 million. Both Chewy and Petco briefly soared last week after Gill posted a cartoon image of a dog on X. And that's your Bloomberg Brief. John.
Amazing. Danny, thank you. Appreciate this morning. We'll catch up with you tomorrow morning. Up next on the programme, setting you up for the day ahead from New York. You're watching Bloomberg Surveillance. We are counting you down to the opening bell, about 40 minutes away, with equity futures just about positive. Your trading diary for the week ahead is absolutely packed. Give me a while. ISM manufacturing coming up at 10 a.m. Eastern, about an hour and 10 minutes away. Tuesday, JOLTS data, plus Fed Chair Jay Powell speaking from the ECB Forum in Sintra, Portugal. Wednesday, another round of jobless claims and tons more economic data. Thursday, remember, US markets were of course closed for the 4th of July holiday, plus the UK holding its first national election in about 5 years. And finally, on Friday, you get the June payrolls report. But before we get to the end of the week, President Joe Biden looking to ease donor concerns with another campaign reception tomorrow. Bloomberg's Mario Parker joins us now from Washington for a whole lot more. Mario, great to catch up with you, sir. Can you just walk us through what we're hearing from people at these campaigns versus what we heard from people after Thursday night?
Well, right now, what you're seeing is a little bit, and I use the term little very relatively, a little bit more calm right after a few days of the voters and the party being able to digest what happened, but also a very aggressive campaign from President Joe Biden's camp to try to tamp down some of these vocal cries for and vocal calls for the party for him to step aside.
The CBS YouGov polling is pretty dreadful. The question, I can share it with our audience again, does the president have the cognitive health to serve as president? For only 27% of registered voters in this poll to say yes, I just wonder how they respond to this, Mario, because that number has got worse, not better.
Absolutely. It's pretty brutal, right? And this is one of the first polls that's out post-debate. What we expect is just an avalanche of polling later on this week, right? A lot of the polling is in the field currently. We're not sure what it's going to look like, but there's a good chance that it'll look pretty brutal and then re-up some of these deafening calls from the party to probably push aside President Joe Biden. The campaign has been very defiant. It hasn't changed course, which may be questionable on its nose as well. It's just saying that deriding some of the public comments from officials who have said that the president should step aside, particularly taking aim at former Trump officials who have podcasts, trying to laugh this off on social media as well, and then saying that the family is staunchly in the president's corner and calling for him to continue on.
Is there a sense of how it would work or who would be chosen if President Biden does choose to step aside, given the fact that there's a real kind of groundswell of feeling that maybe Kamala Harris has to be the person who's put in there, even though there's sort of an understanding that it's highly unlikely that she would ever win an election?
This is the can of worms, right? This is the can of worms that faces the party right now. Procedurally, parliamentarian rules say that it's very hard. It's not insurmountable, but it's very difficult at this point to move the president off of the ballot. The convention, the Democrats' convention, is in Chicago next month. He's got the delegates from the primaries. It'll be tough. There's a tough pathway to do that, right, on its face. Secondly, on the other track, which you kind of alluded to, Lisa, is just the wounds and the can of worms that it would open up within the Democratic Party, the infighting just months before the election, the polls that show that Kamala Harris wouldn't be as strong against former President Donald Trump as other candidates, the jockeying to see who would have the torch from President Biden. All those things will cause just a flurry of infighting, embarrassing infighting within the party, just as it needs to coalesce and gain momentum here heading towards November.
It's going to take some time to shake this off, that's for sure, if they can. Mario, thank you, sir. Mario Parker of Bloomberg down in Washington, D.C. Been through the week ahead, absolutely stacked. The programme is too. Tomorrow, here's the lineup for you. We'll catch up with the former Fed economist, Claudia Sahm. Looking forward to that. John Stolfus of Oppenheimer will be joining us. Matt Miskin of John Hancock and BMO's Ian Lincoln. With BMO's Ian Lincoln, we've got to talk about these bond market calls coming out of this programme this morning.
Given the fact that basically people are saying that yields are headed higher, regardless of what the Fed does, Krishna Memani was saying that basically the Fed is being de-emphasized by the top politics of the moment because essentially you have to factor in a greater likelihood of a Republican sweep and the policies that would get enacted as a result.
What do you make of this call, this two-part story? Short-term inflation spike, long-term hit to growth.
It makes sense logically. The problem is, and this is something people are wrapping their heads around, nothing happens in a vacuum. If the bond market sells off, does it prompt a policy response? Does it have a self-fulfilling feature where it crashes something in the short term? There's a lot of unknowns here that are hard to extrapolate out. Either way, more volatility and potentially higher yields in the near term seems to be the most likely call going forward.
Quite a finish to Q2, quite a start to Q3. The first half is over, the second half still to come. From New York City, this was Bloomberg Surveillance.